Please,
Rema,
let's ourselves if you're
tax, pacho mute my. No money na international tax. Very steady.
Please, let's ourselves if you're
Tax, pacho mute my. No money na international tax. Very steady.
Hey,
Kenya is
someone
your
double the line.
training small profs.
Okay, yeah. All right. Okay, so we are live. Good. So international taxation, I would give you a strategy, right? But for now, I'm just going to focus on transfer pricing so that I don't steer you off course. I hope the videos I shared, you have been able to watch the major ones. I know you'll not be able to finish, but were you able to watch the double taxation and the PE and the residence? Were you?
Yes, you were able to. I was able to, let me see.
That's fine. And how did it go? You got the concept.
Yeah, much clearer.
Good. That's fine. All right. So when it comes to transfer pricing, what are you really? How come? Oh, somebody's using multiple mics. Okay, so let's see. The international tax exam, one, you need to know about the overview of transfer pricing. Let me just call it the mechanism of transfer pricing, right? How does transfer pricing work? You must understand the mechanism, why tax authorities are really concerned with transfer pricing, okay? Once you understand how transfer pricing works, now within this mechanism, you are just looking at how TP works, okay? You are looking at the objectives of TP regulations. I get the objectives of TP regulations. I getting it. You need to know about what associated enterprises, because it's associated enterprises who are usually engaged in TP manipulation. And then you have to look at what controlled and uncontrolled transactions. Are we okay? Okay. So we also have to understand the arm's length principle. So after you understand these things, okay, then next thing you have to know is you have to know the arm's length principle, okay, and its alternatives. So you must look at the arm's length principle and alternatives that can be used for the arm's length what principle. Usually they refer to the global formulary apportionment. I get it, the unitary approach. Think capitalization can also be there. We have earnings stripping. There are so many options we can use for the arm's length principle, like alternatives, right? We can use in place of the arm's length standard or the arm's length principle. Okay, and this one, mostly, they are going to ask you the advantages, that's the pros and cons of the arm's length principle, and then the global formulary apportionment. Now, the third thing you have to know is the application of the arm's length principle. Are we okay? So you have to know the application of the arm's length what principle. So application of the arm's length principle, we have several rules. Like first of all, we have to look at the financial and commercial relations. Okay, so when we say financial and commercial relations, Nankasa, what are we trying to say? So for instance, if I enter into a transaction with you, it's a financial transaction, right? But how did we create that contract? How did we create the commercial relations amongst each other? And there are 5 comparability factors to consider, right? And these 5 comparability factors is what they really want, right? There are other areas that are important though, but however, we don't place so much emphasis in CIT, right? But if you go into the international arena, that's what we used to work. Okay, my job as a transfer pricing consultant, this is majority. Like in Ghana, when we file documentation, this is the kind of work we actually do, right? But then when you go into it, right, things like customs valuation are very, very important. And I'll talk about custom valuation and how it relates to the transfer pricing methods. We have what we call assembled workforce. Do you know that sometimes if your workers that you employ, they work hand in hand, they work well, it can help you come up with cheaper goods and services, which makes your prices low. True or false? True or false? If you use good workers,
It's
do they
true.
waste resources?
No.
No. But at the end of the day, what happens? You have efficient goods and services, right? Which means that at the end of the day, your pricing is adequate. You don't price too much, right? But when there's wastage, you have to compensate for the extra risk. Okay, so sometimes government policies also count. Government policies can also affect the way you price. Okay. Also, we can even look at what? Locational. Are you getting it? Locational incentives. So locational incentives can affect you. For instance, if you're a manufacturing company in Ghana, are you getting it? And then you are located outside the regional capital, you pay tax at 12.5%. This can definitely affect the way you price. Do you get it? So there are so many other things. I mean, these are some of it, right? Even that's what we call MNE. What? So instead of locational incentives, let me call it locational savings. We have MNE group synergies, right? Based on how the group is structured, there are some synergies that they can enjoy, and these ones we'll look at them when it comes to intra-group services, incidental benefits, and other things, right? But these are some of the things that when you're applying the arm's length principle, you need. So sometimes you see them as the basic information that you need for what? Determining a transfer price, or basic information that affects the application of the arm's length principle. Or you can see it as the comparability factors, or the factors that influence the transfer price. Okay, so we'll come and look at it in detail. And this thing, almost every diet, you need to still use them when you're doing comparability analysis. All right. Now, the next thing you have to know about is the transfer pricing methods, right? So straightforward, just from here, I'll give you a clue about how to use the transfer pricing method. So the transfer pricing methods are actually in two forms. Okay, I said they're in what?
Two forms.
Two forms. Okay.
Yeah.
We have the one that requires what? The apportionment of conditions, or simply where we try to what? Find conditions. Okay. And the one where we try to what? Deal with or allocate profits. Okay. So for conditions exist in the form of either a price, okay, a markup, or a margin. Okay. So these ones are called the traditional methods. Okay. So these ones, the ones that rely on conditions like price, markup, or margin, are you getting it? Mostly at the gross profit level. They work at the gross profit level. Okay.
Yeah,
These ones are called the traditional methods. Why traditional methods? Because this one relies so much on comparability. Do you get it? Meaning that this one you can get somebody who has a similar price, somebody who makes a similar markup or similar margin on the market. Do you get it? That is why we call them traditional, because right now, look, if I want to give somebody a loan, I can just walk into GCB, true or false, and look at how GCB gives loan and give the same type of loan to somebody. If I want to sell a share and I have a business just like MTN, I can walk into the stock exchange and look at similar companies like mine and use it to price my shares. So they are comparables. But then, if I'm building an AI automation software that I want to sell, and this software has never been done before, do you think I can easily walk somewhere and see a similar product? Can I?
No.
No, I can't. It doesn't exist. It's unique. So what we'll do is that because we cannot really find a price to allocate, we'll see how much each of my subsidiaries contributed. Then we find a way to look at various components of the software and what independent parties have done and use it to split it amongst ourselves. Okay? Or based on the nature of the activity, it will help us what? Look at the profits that should be adjusted to the group. And this is where mostly our key focus is mostly on what? Only markups or what? Or margins. Are you getting it? So these ones, they are mostly either no comparables. Are you getting it? Or they are unique what? Intangibles, or here massive value, like great value is added to the product or service. Do you get it? So these ones are the things that distinguish between the two different kinds of transfer pricing methods. Now, that's why we have what? The traditional methods. Here we have the cap method. We have the resale price.
And
We have the cost plus. Yes. So the resale price is also known as the resale minus method. So if you go, the examiner can trick you, and instead of resale price, he'll tell you that what is the resale minus method, and you get confused. Don't worry. So under here we have the transactional profit methods, right?
Profit,
So transactional profit method.
profit split method.
We have
No.
transactional profit methods.
Profit method and profit split. Yeah.
And transactional profit methods, we have two methods under. One is what we call the transactional net margin method, and two is what we call the profit split method. Okay, so the profit split method is an example of transactional profit split, where you don't know how to split because there's no price or nothing. So you use the transactional profits that you have made to split for the subsidiaries or the group members. Does it make sense? And this one, we have two methods under it. We have what we call the single stroke method. Okay, and single stroke means you only allocate routine profits. I'll come and explain. For now, it shouldn't make sense to you. Don't worry. So the single stroke is also known as the comparable profit split. I'm giving you all the names. So we call it comparable profit split, or we also call it comparability contribution analysis. Okay. So contribution analysis, that is the name of the single stroke, right? Where you only share the profit they have made. So if you are making a dam, I contributed 20%, this guy contributed 30, this guy contributed 20. We split the profit in that order. So that's single stroke. We only split routine profit. Then we have what we call the double stroke. So the double stroke is normally known here as the residual profit split. Do you get it? Where we split in two phases. Okay. So we first split your routine contribution, and then if you add something extra like a unique intangible or something, do you get it? Then we split that one. So your total profit comes from your routine contribution and your non-routine contribution. So these are the two types of transfer pricing methods, or the two main forms. Some of them rely purely on conditions. They work at the gross profit level, and then they rely more on comparables, right? So that's the traditional. This one, mostly no comparables, or they are unique intangibles, or they offer some sort of great value on the product or service before transferring. I get, and they are highly subjective. So we rather split profits. So they are called transactional profit split method, transactional profit methods. And we have the transactional net margin, and then we have what? Profit split. And profit split can be what? Comparable or contribution analysis, or it can be what? Residual profit split. So the transfer pricing methods, it's not really about knowing the calculation. It's about when to use what method. That's the exam. I said it's about what?
When to use what method.
That's all. And that's all I am going to teach you to master. So that if you see the transaction, I be like, I got you, bro. So that's all.
Hey.
When to use what? You understand? That's all. So if you select a method, you say most questions are like, which method? Are you getting it? And why the which? So always remember this. So which, why that which? So you said the cap method. So why did you select the cap method? Do you understand? Good. So transfer pricing methods, highly likely every single DIT. When you master this, I think you have a high chance. Then once you understand the transfer pricing methods, this is where it gets interesting. Comparability analysis. Now, comparability analysis has been waiting for it for some time, right? Where would made of power nebe and asanko fa. So comparability analysis is simply your transfer pricing report. Okay. And when students here prepare transfer pricing report, hey, then they are running away. This is the easiest thing you can ever get, right? So this time, because of what we are going to do today, I believe with this information alone, you should be able to do very well. I get to assuming this should pop up. There are some steps we need to follow. Okay. And within those steps, everything we've done from the top, you can start applying it. Then from there, we now come and look at sharing of resources, or simply, should we say transfer pricing transactions? So let me say resource sharing. Okay. So when it comes to resource sharing, this is where you now apply everything you've done, right? How groups actually manipulate. This is where they do the proper transfer pricing, like how groups use what? Intangibles. So intangible assets, right? So in the group, when somebody transfers a patent, how do we deal with it? So with intangible asset, the secret is DEMPI. What did I say? The secret is what? DEMPI. Before you cannot see intangible assets with your eyes, can you? If I tell you have a copyright, can you see it? Because you cannot see, if all of us in this class have contributed to the development of some intangible asset, we cannot tell who did what. So the focus is that, remember, the higher the risk, the higher the what?
The return.
The return. Thank you. So here we are looking at anybody who contributed to these things and allocate an appropriate return. So the higher the risk in any of them, the higher return or the higher price that person should be allocated, or the higher profit. So if I'm the one who did the development, I came up with the idea, I came up with this, I did the algorithm, I did this, I applied here and there, then you expect me to be getting more money, right? Because I spent a lot. That is it. The one who did the enhancement, the one who upgraded it, added some features, also needs a what? A suitable return. Then the one who did the maintenance, right, was maintaining it, ensuring that it meets the current standard. The one who did the protection, such that people should not copy. The one who is actually using it. All these people face some sort of risk. All those people employed some assets, and all those people are expecting a return. So that return should be appropriately what? Allocated to them. So intangible asset, the secret is what? Is DEMPI. And this also means you should know the type of intangible you are dealing with, whether it's a marketing intangible or whether it's a trade intangible. So once you're able to get these, you just need to know how that intangible asset can be valued. Are you getting it? Whether it should be valued using the cost approach, the income approach, or the market approach, right? And that's all about intangible assets. The only thing they can go for it is to ask you about how to value intangible assets. There's some intangible assets that are hard to value, and sometimes they are bundled as part of something. It makes them hard to value. And these are all the things. Now, the next thing is that you see, we are dealing with groups, and groups always want to manipulate something the tax authorities cannot see. Okay, so that brings us to the next question, which is what? Intra-group services. Now, assuming we are in a group and we give services to each other, do you think it will be free? It won't be free, because you see, if I'm in country A, which is maybe Mauritius, right? And then we pay tax at 5% in Mauritius, and you're in country B, which is in Ghana, right? And you know, in Ghana, we pay tax of 25%. Always, according to base erosion and profit shifting, we are saying that we want to erode our tax base in the country with the highest tax rate. So, meaning bring down your profits in this country. Do you understand? So, me bringing down profits in the country with the highest tax rate means I'm eroding my tax base. Then I transfer profits. So eroding tax base means either I increase my what? My costs or my expenses. Do you get it? Or I reduce what? My revenue or income. Do you understand? But this guy here, because he's paying a lower tax, even if his income goes up and his expenses reduce, it doesn't matter, because you only pay a lower tax on it. So what we are going to do is that we must create an income for the Mauritius guy by saying that, okay, I've given a service to this guy, he has to pay me, and that service will be very huge. So let's say if I charge this guy $1 million worth of profit, worth of service, now he has gotten an additional expense of what? $1 million, which will reduce the tax. So he will save tax at 25% of that $1 million, which becomes about what? 2.5 million, right? But this guy will have an income of what? Additional 2.5, a tax of additional what? 5% on the 1 million, which will just be about 5 million, 500,000. So that 500, no, 5% is not 500, it's 50,000, right? This guy will only pay an extra tax of 50,000. But if you take it out of this, the total saving you are going to get is about 2,450, right? For the entire group. So at the end of the day, this is the benefit the entire group is getting because of how they position their transaction. Do you get the idea? So I can just give a service to this guy, and then I'll just charge it in my books. But the thing is, was there actually a service? Would you do that service for yourself if you were an individual or an independent person? For instance, if I already have HR in my office, or I already provide HR, then the group also does HR for me. Does it make sense? Does it make sense? Please, let's make it interactive so that it doesn't make sense, right? So even if the commissioner says it's a massa way their manipulation, why? Because you already do HR. Why is the group also doing HR for you? It's duplicated resources. Hence, it doesn't constitute a service. If you do meetings for your shareholders, and you said yes, also a meetings for ML shareholders. I was said
Yeah.
no general meeting. Then you are charging it in your books. So be smart, say no general meeting. It's not an intra-group service. It doesn't meet the definition of a proper service. But let's say you yourself, you requested the head office to come and do a particular service you don't have, like finance. That one is a service. Yes, it is. Because you didn't have it and you would pay any Tom, Dick, and Harry to do it for you. This is the mindset behind these things. They are not difficult. 3, you need to understand cost contribution arrangement. You see, you have all done cost contribution arrangement in your life, but you just didn't know it was cost contribution arrangement. Can we throw more light on this? So look, those times, how many of you have been doing group show? You contribute money and then you cook. How many of you?
No contribution, no chop.
No contribution, no chop.
Yes.
You understand? So no contribution, no chop is the same as cost contribution arrangement. Into the other sikaba na or sandy bowls by no. Obeje more than the one who only brought money. True or false?
Hey, when we're not scanning smooth adults one.
So I'm saying that assuming the money is the same and this guy brought food, he also
Okay.
brought ingredients, he brought cold pot, he brought this. He should get more than everybody. True or false?
Yeah. Very true.
And also, you know that sometimes you can cook now and somebody's mother will come and call him. Then he can't cook the food, he can't chop the food again. Then you have to give the person his money back. True or false?
Emfa.
Baby, but some people they've contributed so much that you have to give him something. So we call that a buyout payment. Then somebody too was not part, but Oba also Tiasi and some mama Nidiane, or you should bring something. So that person wants to buy in. You get it? So we call it a buy-in payment. You get the whole idea? It's like you guys have cooked food. Some people, before the food was ready, their mother came to call them. So you have to give them back some compensation for them to leave because they don't want to be parties again. We call them buyout payments. And the same way, some people too, the food is nice for them. They want to come in. He should pay something to join, right? We call that buy-in payment. So these are what we call balancing payments to join that agreement. Does that make sense? You see, transfer pricing is very fun.
Well, if you
Yes, Prof.
Yeah.
I want you to stop looking at book and bring your mind home. Forget the exam. During exam, there can be a dream see exam, so it will never be clear to you. Bring your mind home. Do you understand? Good.
Yeah.
But you get the whole idea I'm trying to put across, right?
Yeah.
The same way we have what we call financial or financing arrangements. Now, this financing arrangements, what do we mean? These financing arrangements are simply transferring loans and guarantees between group members. Now, would it make sense that banks in Ghana are giving loans to people at 26%? Then you alone, you are giving loan to your fellow subsidiary at 50%. Does it make sense?
No.
It doesn't make sense. So the commissioner even will not allow. Or you give a guarantee to somebody, or maybe a line of credit or something, which is beyond the norms, or even too below the norms. He will think that you guys are doing base erosion and what? Profit shifting, right? Do you get the whole idea? So in our law, this base erosion and profit shifting is what we call income splitting. Okay? Now, that can be found in section 32 of Act 896. Now, we have another one which is quite interesting, and that is dealing with business restructuring. Okay? Now, look at this scenario. Those times, your mother used to buy mori from the market, okay, and come and use it to prepare food. True or false?
True.
But it got to some time, your mother decided that now mori is becoming expensive. So she will now buy her own corn or maize and then go to what? The mill, and then go and mill it and then bring it and use it to cook banku. This is an example of business restructuring. So within the group, if we feel like, okay, the way things have been, we're paying too much tax, so this is what we are going to do. We are going to restructure the way we do our activities so that some certain functions, risks, and assets will be given to some other people within the group so that it will minimize our tax. Then that is business restructuring. So what we've done right now is that we have moved from the the traditional approaches to the contemporary or modern approaches to something like what? Manufacturing. So before we were doing our own manufacturing, but now we have to move to toll manufacturing or contract manufacturing. That's an example. Or before we're
So is
doing...
it the same as tax planning?
Is it the same as...
Tax planning.
All these things we are doing as part of tax planning. No?
Okay.
But this is not tax planning. This is rearrangement or cross-border redeployment of your activities within the group. just to attain some particular benefit. Do you get it?
Yes, sir.
So even your house, sometimes you are getting a visitor, you have to rearrange some things so that there will be space for the visitor to sleep. That's business restructuring. That's what we mean. Do you understand? Good. So once you have been able to know this, that's 1, 2, 3, 4, and 5. Now you have moved from resource sharing to the next area, which is transfer pricing documentation. Now, transfer pricing documentation is something you should be expecting every night, because in Ghana here in Ankasa, if you get transfer pricing work, to be honest with you, it's mostly documentation. So it's mostly the most examinable area. What did I say?
The most
Example
examinable
area.
Why? Because in Ghana, that's the work we do here. Okay. If somebody tells you we do most of this complex stuff, it's the lie. It's the group companies who usually do that. But here, mostly, even the big four audit firms, they don't go that far. We mostly do the methods. Do you get it? Then the documentation, because the country by country report and the master file usually is the foreign companies who do it. So they have their own consultants, which they usually use them, and then we normally do the local file. And even the master file, if you get it, it's not that giddy like that. You only do a portion of it. Do you get the idea? Are we
Yes, Prof.
gradually getting there?
Yeah.
Okay. Ruema, it's like some of your colleagues haven't joined though. Please post the link on your international tax page for them, eh?
They have one.
We are all here.
We are all here.
You, Mate. You, Mate. So the next thing you have to consider is transfer pricing risk assessment. And when we talk about transfer pricing risk assessment, it's simply transfer pricing or audit. Okay, anytime you hear risk assessment is an audit. Okay, the tax authorities assess you for risk. So the documentation that you have sent, when we examine it and we see that no, you are hiding something, we have to confirm the documentation, right? You can't just send something, GRA will accept it blindly. Do you understand? So GRA must come and check whether the documentation you brought is proper. And that's where transfer pricing audit comes in. Makes sense. So basically, the next thing is that after the assessment, we have to do dispute resolution. Okay, we try to resolve disputes, and resolving disputes mostly is where you have your mutual agreement procedures. You can use APAs, you can use safe harbors. I get all these things are mechanisms for dispute resolution in transfer pricing. And these are everything you need to know in your journey of transfer pricing in this exam you are doing. Okay, so you can put them down. Yeah, Sheila, your hand is up.
Oh yeah, I thought when we got to the transfer pricing documentation, you mentioned them, so that's what I raised. Did you hear me? Hello.
Hello. You said you thought I'll mention the types of documentation.
Yeah, the types, the
Okay,
documentation.
so the documentation, we have 3-tier documentation, right? And you see, the documentation is not only the 3-tier documentation. Your financial statement, all those things are part of the documentation. So your documentation, you have the 3-tier documentation, which is your master file. Okay. So when it comes to documentation, this is what you have to know: master file and its content, local file and its content, country by country reports and its content. Then you have to know the transfer pricing returns and its contents. You have to know what we call contemporaneous documentation. And you also have to know the simplified approach. Okay. So you see, usually your transactions that will make you do this documentation here. Okay. Are you following? The master file, local file, your transaction should be above $200,000. Do you get the idea?
Okay.
So before you can apply master file, local file, your transaction should be more than $200,000 for the GRA to even put that stress. For country by country reports, it's for the entire group. So for that one, to be a multinational entity group who does that, you should have made what? A transaction that is over what? 2.9 billion Ghana cedi before you can start doing what? Country by country reports. I said the transaction should be at least what?
2.9.
2.9 billion.
2.9 billion. Now, the simplified approach means that you don't do the normal 3-tier documentation. You only file transfer pricing returns. So the simplified approach, there are two things here. Are you getting it? So when you have low value added intra-group services, are you getting it? And also you have technology transfer agreements. Okay? Technology transfer agreements. So these ones are transactions below what? $200,000. So anytime you have transactions below $200,000, the 3-tier documentation does not apply to you. And also what you have to do is that you have to only file transfer pricing returns. Are you getting it? And your transaction should be what? Less than what? $200,000 dollars. Do you get the idea? But you know, some people are smart about it. Look, is this not a loophole in the law? It's a loophole, right? Because this one, $200,000 or more, will give me stress. I will just break the transactions into smaller chunks. Do you get it? So that I will now apply the simplified approach. But the commissioner says, oh, what? Once you do that, he can put all of them together so that it will exceed. So let's say this technology transfer is one transaction that was $500,000. Then I break it into maybe 10 transactions of 150,000. Do you get it? The commissioner can see that no, this thing, it looks like it's the same transaction, but this guy doesn't want to what? Fall in the 200,000. So he will add everything or what? Put everything together so that it will exceed, so that you can now apply the master file, local file. So it's an anti-avoidance provision. And mostly this is all they can ask you about transfer pricing documentation. There's nothing else. Because in real life, this is even what we do. Only this.
Okay, thank you, sir. The V, what is a compensatory or what?
Contemporaneous. So let me lighten you up a little. I told you we are going to solve a lot of questions. So me, what I'm concerned about is the question. Are we okay?
My
Hey,
parents.
welcome back to Ghana.
Hey, Ade, let's continue.
And give me
Very noisy. Eric, and Florence, please, your background is very noisy. We beg. We are in for business, so we beg you.
I'll
Okay.
find it on the see.
Yes. Hey, please, who is Pamucho?
This is serious, huh? Very serious.
Oh, please. We beg you. Oh, Charlie. Okay, now look at this. Look at this question, okay? I just want you to look at something here. Look at this question. This question appeared in February 2025, question 5. Now, Fuels Limited is a Ghanaian resident company and a subsidiary of Votal Star, a company, I hope you can see my screen, incorporated in Singapore. Votal Star Limited has 2 other subsidiaries. Westwagon, we have incorporated in India and South Vago PT, Private Company Limited, incorporated in South Africa. Now, for the year ended 31st December 2024, the gross revenue for the various companies in the group is as follows. So, you see, they've given us the various companies in the group. Can you all see that? 20,000, 40,000, 80,000,
the
30,000.
question is not visible. We cannot see.
Hey! And they're
if you are using a phone, tilt your phone, tilt your phone.
If you are using a phone, make sure it's
Tilt
landscape.
tilt it, yeah.
Okay.
Are we okay? So do you see that we had how many people in the group? Apart from the parent
4.
company, 4 companies,
3.
right? Good. 3, apart from the parents, so making 4 members in the group. Okay, you see all their revenue. The prevailing Bank of Ghana exchange rate, they've given it, right? The finance manager has recently attended a transfer pricing workshop organized by your firm where he learned about transfer pricing documentation obligations under the transfer pricing regulations, right? Required. He is desirous of knowing whether, based on the financial results of the various companies in the group, you are required to file a country by country what report. What did I tell you? I said you should what? Attain at least what?
2.9 billion
Ghana cedis before you can what? You can file country by country report, right?
Yeah.
Just by doing that alone is 8 marks.
Okay.
Do you get it? But most people miss that. So when we add everything here, how much would that be in dollars?
40, one,
$170,000, right?
170.
Okay, now multiply by 16. That gives us what?
into 2.9.
Yes, but that will give us what? You need the figure.
170 times 16. 2.720,000.
Yeah, so 2,720.
720,000.
Okay, so it's not even up to the billion, right? So
Yeah.
that means they do not qualify. So we call this an excluded multinational entity. Do you understand?
Mm.
An excluded multinational entity. Why? Because this one do not. Excluded multinational entities cannot file country by country report. And therefore, Mr. Financial Manager, you can't prepare and file a country by country report because you are an excluded multinational entity. Because then you continue. See how easy these things are. Yes.
So please, when does the $200,000 come in?
That is when you are not supposed to apply any of the documentation at all. So that means that you don't qualify for master file, local file. So country by country report, right? You are file off cry. You are file off cry. So we use a simplified approach when you only file the returns. Asa.
And the 2.9 billion is the
It's
country by country.
country report, yes. So you can see people who have transactions over 200,000, right? But they don't hit 2.9 billion. So West Wagon, all he's going to do, I mean, Phil West will do master file, local file, but he can't do country by country report. And from the details we are going to go in, that's where I'm starting actually. You get the whole idea, right? I won't start from the scratch. I will be picking where are necessary. I hope gradually you are getting it.
Yeah.
Yeah.
So the 2.9 billion is it in dollars or cedis?
It's cedis. That's why what was in dollars, we converted it to cedis.
Okay.
So the 2.9 billion is 2.9 billion Ghana cedis.
Yes. But the 200,000 is in dollars. It's in dollars. It's in dollars. 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 All right. So, are you ready?
More than
Good. So let's do transfer pricing documentation in detail. Okay. Then we'll go to transfer pricing audit. We are working our way up instead of down. How do you see that? Very funny, eh? So I'm rather going to work my way up instead of down. Idea?
Hello, Prof.
Yes, please.
Please, I need a confirmation. Did you say that where the transactions, the TP transactions, are not up to $200,000, then you will
Apply the
use the simplified approach?
method. Yes,
Yeah.
or the simplified. That one you only file the returns. You don't do master
Okay,
file. Local file.
which involves filing of returns. Okay.
Yes.
Okay.
Are you clear?
Okay.
Yes, yeah, Bafi. Good. All right.
Yes, please.
Transfer pricing documentation. When companies that belong to the same group trade with each other, the Ghana Revenue Authority wants to ensure the prices charged are fair. Okay. So to prove that their prices are fair, companies must keep proper records and submit certain reports to GRA through the Commissioner General. Now, these reports, which we call the transfer pricing documentation, help prevent tax avoidance, profit shifting, false pricing, or what we call transfer pricing, mispricing or abuse, and tax fraud. Okay, that's why you file documentation with the authority. Does that make sense? So this chapter, we are going to look at the important documents that are required under the transfer pricing documentations for your exam. Okay, the regulations. Now, we have to understand key definitions, and these key definitions can come as terms in your exam. I said they can come as what?
Terms in your
Terms in
exam.
our
Terms
exam.
in your exam. So they can tell you that what is a surrogate parent entity. This is where it gets interesting. So when we say surrogate parent entity, what does it mean? A surrogate parent entity is a company that has been chosen by a multinational group to file the country by country report instead of the ultimate parent entity. Wow. So it means that within the whole group. So let's use Amenfi Group as an example. Look, if you look at it, Amenfi West is a Ghanaian resident company, right? And he's a subsidiary of Voltal Star. Do you get it? So Amenfi West was a subsidiary. The parent is Voltal Star. Now, which of them is in Ghana? West is in Ghana. So assuming now they decide that they are going to now do the country by country report, who would they make the surrogate parent entity? It's Amenfi West, because he is in Ghana. So we can say that, okay, all the group country by country reporting requirements, we want you to be handling it. So Amenfi West now becomes what? The surrogate parent entity. Does that make sense? Even though the ultimate parent was Votal
So that I
Star.
can see the thing clearly. So this is the platform. So which of them did you join?
Please, did you get it? Did you get it?
Yes, sir.
So what is a surrogate parent entity?
It's a company chosen
A
by
company
multinational.
that is chosen by the group
A company
to
within the
file
group
the
that has
country
been
by
chosen.
country.
Yeah, it's the one that the group has chosen to fulfill their what? Country by country report obligations. Do you understand? Good. So that's a surrogate parent entity. It files a report on behalf of the entire multinational entity group. So sometimes the main parent company cannot submit the report, and the multinational group then chooses another company within the group to submit it instead. So that company now becomes a surrogate parent entity. Think of it as a backup parent company. Makes sense? So, for example, if ABC Group owns companies in Ghana, Nigeria, Kenya, and South Africa, the parent company is in Kenya. Suppose Kenya cannot submit the country by country report because it has no qualifying agreement with Ghana. ABC Group appoints its Ghana company to file the report, and the Ghana company now becomes a surrogate parent entity. Did that make sense to everybody?
Yes, sir.
Yes,
So remember, surrogate parent is the same as backup parent. So let's look at the reporting fiscal year. So when you hear reporting fiscal year in transfer pricing documentation, we mean that the financial year whose information appears in the country by country report. What is it? The financial year whose information appears what? In the country by country report. So the year being reported. So if the company prepares account from 1st January to what, 31st December, the reporting fiscal year is what, 2025 or 2026. Do you get it? And the country by country report will only contain information relating to that year only. Makes sense? Now, we have to understand, hey, please, the background noise. Please, who is that?
Faris.
Oh, Charlie. I said distorting me. So, when we say multinational entity group, we mean a group of related companies who operate in 2 or more countries, okay? So companies located in different countries, or even a company with a branch in another country. They can trick you. Let me explain how they can trick you. Instead of you seeing group companies, they'll bring you a company with about 3 PEs, branches, offices, workshops, mines, and you think that, oh, these are not group companies. They are, because even our act, when you go to section 107 and 108, it said activities between the PE and its parents shall be treated as persons in controlled relationship. So it means you treat them like a group. Do you get the idea? So group companies are what? A group of related companies operating in 2 or more countries. Are you getting it? So the group must not be an excluded multinational enterprise group. And I told you excluded multinational enterprise group is the ones that cannot file country by country report because their total cumulative revenue is below what? Is below how much?
200,000.
2.9.
Oh,
2.9 billion.
please don't mistake it. I didn't say transfer pricing documentation. I said country by country report. I was specific. Country by country report is 2.9 billion.
2.9 billion.
I didn't say transfer pricing documentation. I was specific. So when it relates to country by country report, it's 2.9 billion Ghana cedis. Is it clear?
That's okay.
Yes, sir.
Good. Now let's look at what? An excluded multinational enterprise. An excluded multinational enterprise group is a multinational enterprise group that does not have to file a country by country report because it is below the required revenue threshold. Do you get it? So according to the regulations, the group's total consolidated revenue in the previous financial year must be less than 2.9 billion to be an excluded multinational enterprise group. Do you get the idea? So small multinational, it means you're a small multinational entity group. You don't prepare country by country report. So if ABC Group earned 2 billion last year, since it's less than 2.9 billion, they become an excluded multinational enterprise group. They don't file country by country report. But when they earn 5 billion, what happens? It means that they're above the 2.9 billion. So they are no longer excluded. Makes sense?
Yes, sir.
The next term we have to understand is what we call consolidated financial statement, right? So the financial statement that combine all the companies within the group into one financial report. You know that already. I won't waste my time on consolidated financial statement. Now, the next thing you have to understand is what we call constituent entity. So when we say constituent entity, we are looking at any company, branch, or business unit that belongs to the group. So any company within the ABC group or the Votal Star group is a constituent what?
Entity.
What happened? I'm asking a question. Oh. I said, what's an excluded multinational enterprise group? Because I know why we've got into. Yes.
They are not required to call the country by country
reports.
reports because they don't meet the 2.9 billion.
Threshold. Good. That's one. Two, what's a surrogate parent entity?
They've been chosen by
That is selected by
the
the
group to
parent to
File
file.
country
all the
by
country by
country
country
file
reports.
instead of the ultimate parent entity.
Hearing.
Okay. And what is a constituent entity?
Any company that is inside or
Belonging to a multinational group.
Okay. What is consolidated financial statement?
They consolidate the group report into one.
Preparing one account as though for a number of entities as though is one entity.
Okay. What is multinational enterprise group?
A group of related countries operating in two or more countries. Hey.
Good.
Okay.
Good. So, do you know what we're going to do? Let's understand the most important. You remember I wrote something called contemporaneous documentation. And your examiner can ask you, what is contemporaneous documentation? Now, these are the documents that are prepared when the related party transaction is being planned or carried out, not years later. So this is what it means. All the documents, financials, records that existed at the time you were doing the transfer pricing transaction or when you decided to do the transfer pricing transaction, not years after it has been done, but the things that were there as and when you were doing that transaction is what we call contemporaneous documentation. So the time I was entering into the agreement with you, I had the financials, I have the pricing list, I have the bill of lading, all those things form part of your contemporaneous documentation. Do you understand? So a simple explanation means that contemporaneous documentation is simply when you're entering into a transfer pricing arrangement, prepare the records immediately. Don't wait until GRA asks you to prepare. Do you get the whole idea behind it?
Yeah.
Do you get what I mean?
Yes, sir.
I mean that if you're entering into any transaction, prepare all the records and put them down. That's contemporaneous documentation. The records you have prepared down as and when you are doing the transaction or before you do the transaction. Don't wait until GRA comes for an audit before you start preparing them. Do you get the idea?
Yes.
So, assuming we sell products to ABC Nigeria, before making the sale, ABC now prepares what? ABC Ghana prepares what? The price calculation, the agreements, the comparable prices, the supporting document. These are all contemporaneous documentation. Makes sense? You see, when you understand, it becomes easier. I like to break things down rather than make it complex. Because this one, if a question comes, you can easily spot contemporaneous documentation because you understand. Makes sense. But let's look at the wrong example. For instance, if you wait, then you did the what do we call it? The transaction with ABC Nigeria, everything is done. You have some of the document, but not all. So you wait 3 years before preparing the document. These will not be called contemporaneous documentation. So the documents that are there, they are as and when no, is contemporaneous documentation. But if it is later after the thing has happened, cry in some years' time, then it is not contemporaneous documentation. Is it clear? So in simple terms, contemporaneous means at the same time. It means what?
At the same time, life.
At the same time.
Or by rehearsal live, or by term, or by shall say 5 at the same time, right? Good. So transfer pricing return. Every person who enters into a transaction with a related company must submit a transfer pricing return. Now, when do you file a transfer pricing return? Within 4 months after the end of the accounting year. What did I say? Within what?
4
4
months.
months after the
end
end.
of accounting year. So if it is 31st December, you file by April ending. Does it make sense? Please don't forget this. So these are the things they actually ask. Are we clear?
No.
I said if this is 31st December, you file your transfer pricing return at the end of April next year. 4 months after the end of December, if that is your accounting year end. So you count January, February, March, April. Is it clear now?
Yes, please.
Good.
Hello,
So
Prof.
And sir,
yes, please.
please with the country by country.
Please one by one, I beg you. Yes,
With the
you
country by
please go on.
country, I believe they file it theirs within 12 months after the reporting period.
Yes, we'll come there. For now, we are just doing
All
it
right.
step by step. Good. Now, Manche, please, your question.
Please, if a foreign entity has a PE and there's a transaction between the PE and the parents, let's say in terms of construction, are they supposed to file the transfer?
Said if they have what? Please, sorry.
A foreign entity has a PE, a construction, like a
Okay.
construction PE.
Okay.
And there is a transaction between the parent company and the PE. Are they supposed to file
a transfer pricing return? Of course.
Okay.
You are related parties. The law, I told you the law, recognizes transaction between a PE and its parent as though they were present in a controlled relationship. Yes, it means you qualify. But the thing is, you must still check very well whether you constitute a group and the nature of the transactions. Do you remember? Yeah.
Yes. Thank you.
You're welcome. Any other question or we are fine?
Please, the contemporaneous document. Can you take it again, please?
Contemporaneous, same time. Yeah, I like yours, man. It's been a while.
Yes, because I just realized it's you. I didn't know.
It's fine. So
Yes,
we are
sir.
saying
Yes, sir.
that contemporaneous means the same time. Do you get it? So any transaction I'm entering into, all the document that pre-existed at that time I was entering the transaction. For instance, if now I've what? We have entered into an agreement and you have to ship goods from China, the bill of lading and the documents that came with it at that same time is contemporaneous. So the live documents. Alaja,
Prof,
yes, please. Mike.
it's just
Yes,
like
sir.
the
Yes,
word contemplate the document that you'll be needing when the GRA comes. So
That's all.
Live
You've
it's
said it
more of the
perfect.
literal meaning of the word.
Yes. So the
Okay, sir.
live
Thank you.
documentation we need. You are welcome. So the
Okay.
live documentation we need, as at that time we are entering into the transaction, that's contemporaneous. Makes sense. So are we okay now? So we said you must submit a transfer pricing return. Now the filing deadline is within 4 months after the end of the accounting year. I didn't say the year end, though. I said the end of the accounting year. So if my accounting year ends in what? June, it means I must do it when? When must I file? July, August, September, October ending. Aha. Do you get it? Good. So what should be on the transfer pricing return? Your TIN number. We said we shouldn't say TIN number, but I want to go layman's terms. So we say TIN number. Your TIN. Are you getting it? Then the relationship you have with the associated companies, the group structure, the total group revenue, the related party transactions, the business activities, the property that was used, the transaction values, how you calculated your transfer prices. Do you get it? The method that you used, the arm's length range, the range of prices, right? The business strategies and your consolidated financial statement will also be attached. Are we okay? Are we okay? Do you want to write something down? Because sometimes they can ask you for the content.
I've been filing this for my group. I don't even go through to find out what it is.
You see that thing. So these are the things they ask you in the exam. It's not that it's out of way. At the end of the day, you just need to stop thinking about exam and bring your mind home. Do you get it? That's why sometimes you're in a hurry and you forget your car key. You be like, oh, my car key, I can't find it, but it will be in your hand. It's because your mind is not home. So come home, come home. All right. Please, are we okay? Please, can we move?
Yes, but it says you said we may want to write something. Oh, okay, but it's on the screen. Thank you.
Yeah, you're welcome, sir. All right, so you can just take a shot and then we move.
Yes.
Right. Okay, so somebody who has taken the shot should just put it on the page so that it will help all of us. So GRA can also require special information from you. Do you get the idea? Which is outside this one. So you can still well, just so they want to know the nature of your transaction. Remember, GRA is not a magician. If there's something new GRA doesn't know about and you file it, they have to ask further information to know more about it. Do you understand? Then they can now add it to their toolkit of knowledge. That's how we do it. Even you, if you don't know something and you get it for the first time, you add it to your pool of knowledge. Is that not so? So GRA also requests further information to further understand the transaction. And now that we are more in the world of AI, you know, new things are coming up. Are we okay? So for instance, based on what we were saying, if at the end of the year, we said ABC Ghana sold goods to ABC Nigeria, do you remember? So if at the end of the year, ABC files their transfer pricing return, it should show what the sales value, the pricing method they use, the supporting calculation, and the relationship with ABC Nigeria. If the transaction is somewhere and GRA said, okay, I want to understand the nature of your business activities and the kind of what taxes you deal with in Nigeria, it will also be attached so that we can understand more of the transaction. Make sense? So that was the transfer pricing what? Return. And I told you when you're under the simplified method, that is all you file. Do you get it? What is a simplified method or simplified approach to transfer pricing? I'm asking the class.
The 200,000 US.
No.
This when
Asking you.
your transfer pricing transactions do
So
not
in the
reach
exam, if I ask you what is a simplified approach, that's
200,000.
what you tell me.
If your revenue does not meet the threshold for
You have not answered my
filing,
question. I asked you a question. What is the simplified approach to transfer pricing? The simplified
It's
approach to
about
transfer
filing
pricing.
the PPE return.
You
The
have still not
200,000 and the low what's it? Low value intra-group.
Inti about exam one can say now better no. Hey, this is a method or an approach to transfer pricing documentation that requires one not to file the 3-tier documentation. It only requires the filing of what? Transfer pricing return for transactions below what? $200,000. Where these transactions involve what? Low value added intra-group services and technology transfer agreement. But on the other hand, if transactions that are below 200,000, are you getting it? Can be subject to what? Maybe anti-avoidance restrictions by the commissioner when the group decides to work the transaction in piecemeal. I told you exactly this, didn't I? So what is it? If they ask you what it is, you must first tell us what it is. Don't just jump to the transaction. That's not how you answer questions. What is it? It is an approach to transfer pricing documentation. True or false? True. 2. What does it require? That your transaction, you don't file the normal documentation. True. 3rd, what does it require? Transactions below 200,000. True. What else? These transactions below 200,000, we can only accept low value added intragroup services and technology transfer agreement or arrangement. That's cool. You get the full mark. Don't just say where the people. No. What is it? First, you must tell us where it falls. Then what goes into it. Somebody is on the page asking, what is this about, please? Hey, it's serious. So What goes into our master file? Now, the master file is what the entire group must prepare, right? It contains information about your entire group worldwide. So the whole world, what the group does, goes into the master file. So we have various local files across different countries, right? But the entire group worldwide will bring all together into what we call a master file. Now, the master file must have your group structure, your ownership structure, the group chart, the countries you operate, your major products, your supply chain, the main market you operate, your group services, if you've done any business restructuring, the most important part, your independent intangible assets. So the patents you have, your trademarks, your copyright, any R&D you are doing, right? Intangible assets. I told you that intangible assets are mostly issues. Then what? You have your financial activities, like if you have any loans and guarantees you are giving people, the central finance company, are you getting it? So your audited consolidated financial statement, any tax rulings and advanced pricing arrangements. Okay, so all these things are mostly found in the master file. Are we okay? So example, let's say that if Prof Group has company in Ghana, Nigeria, and Kenya, the master file will explain how the entire Prof Group operates. Are we okay with the master file now? Are we okay with the master file now?
Yes, but please, I want to write, or if you can snap as well.
Yeah, if you can go back so that I will
You
take
can
some.
go to the transfer pricing regulation is there. So it's just a summary.
Oh, all right. Okay, thank you.
Okay, so the local file, let's just understand so that we can do a lot within a short time, right? Because as time is going, then people are getting tired. So local file is information about the Ghana company only. So if one of the group members are in Ghana, okay, whatever that Ghana group company does in Ghana is what goes onto the local file. Is it clear? So your management structure, your business strategy, your competitors, the related party transactions. So like if Amenfi West had another subsidiary here in Ghana and they transact amongst each other, I get all those things will be in the local file. Any royalties, licenses, comparability analysis, the transfer pricing methods, and your financial statement. So, for instance, Profs Ghana will prepare what local file explaining only our Ghana operations. Does it make sense? Does it make sense? So, when do
It
we
does, it
also
does.
file the master file and the local file? When do we file them? Same date as the return. Do you get it? Same date as the return, 4 months after the year end. But then when it comes to the country by country report, we file it within 12 months after the fiscal year. So if this is 31st December, we'll file it 31st December the next year. Do you understand? So country by country report is 12 months after the reporting fiscal year. And you know what the reporting fiscal year is. I taught you, didn't I? So what goes into it? So this one will have what? The revenue, profit, income tax paid, income tax accrued, the share capital, retained earnings, the number of employees across the group, your tangible asset, the countries you operate. I get it. This one are all aggregate too. So you should have the aggregate of these things, the business activities, the list of constituent entities. You should have an aggregate of all these things. That's what goes into the country by country report. And we know that what? You can't prepare a country by country report if you're an excluded what? Multinational enterprise group. Do you remember? What is an excluded multinational enterprise group? We said
An
is what?
enterprise group that's not supposed to file country by country because it earns more than
Ends
2.9
less
billion.
No,
than
Less than 2.9
2.9
billion.
billion Ghana cedis.
Yeah, 2.9 billion Ghana cedi or 2,900,000 Ghana cedis, right? Hey, 2 billion
Yeah, right.
900 million Ghana cedis.
Ghana cedis.
Yes.
Is it for a year?
Yes, it is for that year, fiscal year involved. So maybe this year you don't meet the criteria, but next year you meet, you may file. Next, the following year you don't meet, you don't file. That's how it works. So why is the country by country report important? It helps GRA to identify transfer pricing risks. It helps detect tax avoidance, assess your compliance, and help you carry out what? Economic analysis. Now, one thing that becomes very interesting is you must be very confidential with these things, right? So the GRA must keep what? All information in the report what? Confidential. So let's look at the simplified approach or the simplified documentation rules. So some taxpayers do not need the full documentation. This applies where the value of the related party transaction is not more than the what? The Ghana cedi equivalent of the $200,000. Do you remember? Do you remember? We mentioned this, didn't we?
Yes, sir.
Yes,
Okay.
sir.
So, however, if several small transactions are deliberately split to avoid the limits, the Commissioner General may combine them. Did I mention this?
You did.
Good. So that's a simplified documentation rule. So it covers what? Low value adding intra-group services. Now, with low value adding intra-group services, like things that are routine, right? They don't have any profit like that. Let's say if you are doing routine support services like administrative functions, you are using what word do I even want to say? Where you use receptionist services, things that are routine. I get a normal filing. These are things that if I'm doing for you, I don't charge so much because it's routine. Do you get it? They are low value adding. They don't add substantial value. Because they don't add substantial value, we use mostly what? The cost plus method, right? And then the markup we put on it should not exceed 3%. In the OECD model, the markup is 5%. Do you get it? But in our transfer pricing regulations, it's 3%. So when you are doing a question, you must suggest all to the examiner that even though you are applying 3%, right? The OECD method, the OECD model says we should use 5%. So something like simple administrative support service, they are low value adding. They don't really add substantial value. Do you get it? That's why we take a cost plus method with what? A markup of at least 3%. Do you understand? Good. Now, what services do not qualify for this? So when you are doing core business activities, something like R&D, manufacturing, production, you are purchasing raw materials, you are doing sales, marketing, distribution, major financial services, you are doing mining, insurance, senior management services. You see, the simplified rules will not apply because these ones are not low value adding. Do you get the idea? Do you get the idea? Do you get the idea?
Yes.
Good. So the next one is technology transfer agreement. So with this one, when you are transferring any technology, okay, you may qualify for the simplified documentation where the agreement is registered with what the GIPC, Ghana Investment Promotion Center, and the charges fall within the approved limits of GIPC's requirement. Okay, so you must notify the Commissioner General within 30 days after you do it. You get it, and you should have the description of the technology you transferred, who and who are involved, the purpose of the transfer, what benefits are you expecting to get, how did you allocate it, I get it, and the amount charged. So once it is being approved, the election will what remain mostly for 3 years. 3 years you have to renew. Are you getting it? So that's how these ones work. So that was all about transfer pricing documentation. Let's move to transfer pricing audits.
Sir, please, the simplified approach, can you summarize it?
What summary again do you need? Anytime you are doing transactions below $200,000, you use simplified approach. Simplified approach means you don't do master file, you don't do local file, you don't do country by country reports. Country by country reports, you are so far away from it because it's 2.9 billion to cover. Do you understand? Simplified, there's a normal documentation. They are Do you get it? You just file the transfer pricing what report, returns. That's all. And transactions that qualify for this simplified approach is low value adding intra-group services and technology transfer agreements. That's all. Is it clear now?
Yes, sir.
So transfer pricing documentation going. Is it gone? It's gone. Is it gone?
Gone.
It's gone.
It's gone.
Whether we like it or not, it's gone.
But you understood it. But you understood.
Yes, sir. Yes, sir.
Good. Okay. So now we are going to look at transfer pricing. What did I say? Transfer pricing risk assessment.
You said
Or
audit.
yeah, that's the same as transfer
Audit.
pricing risk assessment.
Okay.
Yes. So risk assessment is simply how the revenue authority calls an audit. Okay, so the audit is called risk assessment. Okay. So we are going to look at transfer pricing risk assessment in detail. And I'm going to also, okay, when we come to the arm's length principle, I'll cover that bit. But then let's look at transfer pricing audits. I'm coming. Yeah. Okay. If you can see my screen, you let me know. Okay, so transfer pricing risk assessment or transfer pricing audits, when we go to our regulations, okay, it tells us that the Commissioner General, when he receives a transfer pricing return or documentation that is filed, I get in respect of an arrangement, he may what? Examine the amount that was charged to the financial statement or credited to the financial statement. When we say an amount is charged, we mean an expense. When an amount is credited, we mean an income of the person who filed the return in respect of that arrangement. Are you getting it? To determine whether the amount is within arm's length what range. Are we okay? So despite the above, the Commissioner General may conduct an audit of a person, even though you have not filed a return. What did I say? What did I say? This is the most important thing. One of the important things that examiner can ask.
Despite the above, the Commissioner General may conduct an audit of a person, even though.
Do you understand? What is the above? The above is that the Commissioner... You're repeating the above. No, I want you to mention the above. What is the above? The above, Nesiden.
Charged to the financial statement or credited to the financial statement.
No,
Yes,
the
with the
transfer.
amount. You said? Somebody was saying something. I don't get you.
Examine the amount charged to the financial statement or credited to the financial statement.
So we are saying that even though you may have not done that, the commissioner can still audit you. True or false? And when we're looking at the triggers for an audit, we said that sometimes when some third-party information has reached the authority or they have examined that some of you are doing related party transaction, they may audit you. Do you get it? Do you remember?
Yeah.
Yeah, so they may audit you. And these are some of the things that you really have to look at and consider. Do you understand?
The biggest surprises.
So we just saw some of the things that what the commissioner will do and may even audit you when you have not filed a return. So what does the commissioner normally do during a transfer pricing audit, right? For the purpose of carrying out a transfer pricing audit, he can examine the documentation file for the transfer pricing, right, to determine whether the most appropriate transfer pricing method has been applied to the arrangement. He can apply the most appropriate transfer pricing method to the arrangement where the commissioner is satisfied that the person who filed the return did not apply the most appropriate transfer pricing method to the arrangement. So let's say you use the cost plus method, but it was supposed to be transactional net margin. The commissioner during an audit can rather apply that method and compare to what you had and find the difference and add it back to your profit. Okay. So the commissioner can also, that method that the commissioner used, he can provide reasons for selecting that method other than the method you selected. Do you get it? So during an audit, these are some of the things that the commissioner can actually do. Are we okay? So if they are selecting you for an audit, you see the triggers for selecting a taxpayer for an audit. Do you remember?
Yeah.
Yes.
Those are the same triggers we use. Are you getting it? For selecting a taxpayer for an audit. Come in. So we are saying that when they are conducting a transfer pricing risk assessment or audit, are we okay? The selection will be based on effective risk identification methods. Are you getting it? Which may include system-based data analytics based on GRA's own system. Are you getting it? Like looking at the industry or sector. Are you getting how risky it is? Are you getting it? If you engage in transactions with related parties, when you have made a lot of losses, Are you getting it? You are working, you are transferring things from low tax to high tax jurisdictions. You have centralized supply chains in low tax jurisdictions, or you have exhibited poor performance relative to the industry or the group. So let's say that groups of this nature operating the hotel industry, right? Mostly, even if they will make profit or they'll make losses, Ghana is very small. Are you getting it? Because they are high volume transactions. So let's say that in your group, in the industry, people make profits all the time. Then you alone, you have filed losses for the last 5 years. Shouldn't we audit you? It doesn't make sense, right? It doesn't make sense, right? No, in your industry, people always make profits. People always make profits. Let's say hotel industry. Do you get it? Then within, you are also operating in that industry, but you've been making losses for the past 5 years. Does it make sense?
Yes, 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 yes.
So they should audit you because their work can ask a no credit.
That's true. Yes.
They are sharing party jollof. You alone, you came back, you said you didn't get anything. Should we believe you?
No.
It doesn't make sense. Do you get it? So you must prove to the authority why. That's why we need to audit you. Do you get it? So during a transfer pricing risk assessment, we pay particular attention to companies with various risk indicators, like transaction with related parties in jurisdictions with aggressive transfer pricing rules, poor or inconsistent financial performance, significant intercompany transactions relative to total volume, inadequate transfer pricing documentation. Are you getting it? So tax administrations conduct critical analysis of corporate tax and transfer pricing returns. They review publicly available information. They conduct site visits and utilize data from customs and exchange of information. Are you getting under the tax treaties? If it is deemed to have significant transfer pricing risk, we may be selected for a full-scale TP audit. Are you getting it? Based on the findings of the review. So this review is carried out unbeknownst to the taxpayer most of the time. Right, so it is done on an emergency, like the way we do emergency audit. Are we okay? Are we okay?
Yes, sir.
So after doing the audit, sometimes we pass some sort of adjustments to your account. Are you getting it? And then they can ask you the types of transfer pricing adjustments. So transfer pricing adjustments are actually 3. But in modern days, they've brought another one, which they will not even ask you in your exams. I'll not even worry myself. I'll only stick to the 3, okay? So before it was just 2 before the corresponding one. Are you getting it? So before it was primary and corresponding, then they brought secondary adjustment. Let me explain. So look, assuming I transferred some goods to you, okay? Let me show you. So assuming I transferred some goods to you, okay? You are in UK, I'm in Ghana. Are you following? Then let's say that I transferred some goods to you, which was $10,000, right? So I transferred it to you. To you, it is what? A cost. To me, it is an income. True or false? So you reduce your profit by $10,000. But then the commissioner saw that the actual price of these goods was $5,000. It means you have understated profit by what? $5,000. True or false? So because you are in Ghana, the commissioner will add back 5,000 to your profit. We call this a primary adjustment. Do you get it?
Okay.
The UK authorities must also deduct 5,000 from your income. We call that the corresponding adjustment.
Some link on the platform. I think about this problem. So
Does it
I
make
don't know what
sense? Hey, please, who is that?
people are
Who
doing.
is that? Who is that? Oh. Did you get the rule?
Yes.
So the one that Ghana will make for this transaction, the adjustment Ghana will make to our profit for this transaction is called what? The primary. Then the one that UK will do, the corresponding one that looks like ours in UK is what we call what? Corresponding adjustment. Not secondary. Some people confuse the two. The secondary adjustment means that let's do the transaction as if the whole transaction was actually done as the 5,000. So we'll say that, okay, assuming the UK guy transferred the whole thing at the 5,000 to the Ghana guy at the 5,000, what would have been the profit and the position of the group? That is what we call secondary adjustment. So we do the thing as if the thing was never manipulated. Do you get the idea?
Yeah.
So those are the types of transfer pricing adjustments. So we first have the primary adjustment, which is the initial step in the process. This is where the tax authorities will make modifications to a company's taxable profits if its pricing scheme deviates from the arm's length standard. For instance, if a product is sold between related parties at a price lower than the arm's length value determined by the tax authorities, the company's income is adjusted upwards by the shortfall amount, like what we said. So if expenses claimed exceed the arm's length price, the same way we do a downward adjustment. Do you get it? But then a corresponding adjustment serves to maintain consistency in the allocation of profit between the tax jurisdictions. So they are made by the tax administration in one jurisdiction to offset the primary adjustment made by the other. Do you understand? So it actually goes this way: primary before corresponding. Makes sense? So if I do an adjustment here and then Togo tax authorities do it in the other country, what type of adjustment is that? We
Corresponding.
said corresponding. Thank you.
Corresponding adjustment.
The one I do in Ghana will be what? Primary
Primary.
adjustment.
Primary.
The one that would be done in Togo will be what? Corresponding
Corresponding.
adjustment. Thank you. So that one is to maintain consistency in how we allocate profit, right? So the other competent authority will do it to offset the primary adjustment that has been made by the authorities in the other country to ensure symmetry in the treatment of the intercompany transactions. Are you getting it? So it aims to mitigate the risk of double taxation, but it may not always match the amount of primary adjustment, because maybe the rules we use to add back the 5,000, maybe Togo will not add back 5,000. Maybe per their rules, 1,000 is allowed. Do you understand? So they will only adjust only 4,000. Do you get it? So don't assume that whatever primary adjustment you have been done in your country, the corresponding adjustment in the other country will be the same. Sometimes it is. What if their rules are different from ours? It may be different. Do you get the idea? Do you get the idea?
Yes, sir.
So then what is a secondary adjustment? It complements the primary adjustment by introducing constructive transactions based on the premise of notional transactions. So this adjustment creates hypothetical scenarios reflecting what would have occurred had the transactions been conducted at arm's length prices initially. Do you remember what I was telling you? That secondary adjustment means assuming we actually transferred the thing at the $5,000 and not the 10,000, what would have happened? Do you get it? So we do the thing at the real prices. We don't use the other one. So yeah, we don't. The adjustment itself is reconducting the transaction using a hypothetical scenario. Okay. Okay.
Okay, sir.
Pricing audit and transfer pricing adjustment. Yay. So now it seems whatever we've done is vague, right? I say, now, Prof, this thing there is easy. Yes, I know it's easy. So let's take an actual question to put what we have learned to practice. And I'm sitting.
Prof Swaso.
All right. I hope I'm not complicating anything for anyone.
No.
Good. So, Yansha, don't go
No,
for me.
just that is plenty.
Yendu baby.
Adia, Uncle was say, see, Adia Uncle was only 2 weeks trail. No. 2 weeks is piano. They just some few, like 1 hour be a trail, and you said it's plenty. Now you've learned all you can learn. No. Here you are just taking what? Last minute brush ups. Do you get it? So that you're going right.
That's
it's
how
not that you are going to learn.
I feel like learning.
Some of us are not learning.
We are now learning. No.
Last minute.
No leave, nothing. So we are now.
Oh,
why do you think you need leave to learn?
Because we
Prof, give us the questions.
No, you guys learn as if you are still in the university. Who said you have to have a book in front of you before you learn? That's the wrong approach to learning. You are learning every day. Things you don't know, you are always watching. Every day you see signboards on the road, you read them. And that is also learning. So you convert your learning and make it easier. Record these things onto your phone. Delete some of the music. You can put it on your phone. Make use of your environment as learning materials. Who said you actually need a book to learn? That's the mistake you guys are making. That's why you always need to sit down 3 hours to learn. You can do 20-minute sprints just every day, just 20 minutes of your time. It's better than somebody who will get up in the weekend and sit down 5 hours. Nothing enters your head. You see, you make the conditions suitable for yourself. Excuses will never help you. I know somebody who is juggling 4 jobs at the same time and he's able to pass a paper with high marks all the time. How does he do it? He makes use of his environment. Record these things onto your phone. Be playing them. You are in the kitchen cooking, then it's on play. You are in your car in traffic, then it's playing on your Bluetooth. Do you think you won't remember? You are learning the wrong way. Some of you learn as if you are still doing academic courses. You need to sit down with book in front. No, behind your office, you know that CITN and now ICAG. No, sir. Early morning, you wake up, you write a summary of maybe transfer pricing documentation, put it in your bag, or take a snap with your phone. What during lunch you are munching on something, then you are doing it. Record yourself on video. Once a while, you play it. Then the areas you practice questions when you don't understand, you go and then what? Go and check.
It's a project on its own.
Do you get it? Who said you need 3 hours to learn? You can be in the office and say, okay, let's say subsidiary A acquires subsidiary B. And then we have 4 subsidiaries in the group and their total revenue is maybe $500,000. Okay, $500,000. Let's take exchange rate at 10 cedis. So that will give us 5 million. It's not up to 2.9 billion. So should they file transfer pricing documentation? Yes, they will file, but they won't file country by country report. Why? Because they are an excluded multinational entity group. You are sitting, your brain cannot literally tell the difference between what is real and what is not. If you create scenarios in your brain and you are learning, your brain thinks you have actually taken a book and you are learning. Who told you I didn't get leaves? That excuse is what I don't want. You are not learning the right way. You see, learning, no, it's something you do every day. But some of you want book to be in front of you before you consider it learning. So you have tricked yourself. So until book is not in front of you, nothing you do is considered learning. Somebody said he doesn't have time, but he'll go and sit in front of a computer or his TV and be watching lectures. Listen, be watching lectures. No notes, no write-up, 4 balls of banku in front of him with chilled coke, not a lecture in him. You are watching movie, massa. It's not lecture. One time, one guy joined the class. He was watching the lecture. His video was on 4 balls of banku with chilled coke, with his wife massaging his shoulder. Okay. Massa. That
Prof.
one is not learning. No. You are just watching. We told him to even turn off his video. You see? So please change the approach. Within these few days, you can do something magnificent and you will get it. Do you understand? I want you to tune your mind. Forget about leave and those things. It's a circumstance you found yourself inside. So how do you make the best of it? Excuses will not save you because nobody cares. You pass or you fail, it's in your hand. So have you actually achieved your goal? That's in your hands. I keep telling you that. It's up to you. So stop giving complaints and start making the best of the little you have. That's how you make it. Warriors don't complain until the battle has ended. So are you winning or you are losing? Think about it. Does it make sense? Good.
Yeah, thank you.
You're welcome. So
for
forget
the
leave.
advice.
Whether leave or no leave, make the best of it. And that's where you get the satisfaction that actually may not leave, but my clock if I know. Hey, we're a champion. That is it. That's how it should be. Do you understand? Good. All right. So February 2024, question 4. Adonko Famiko happened. Let's see. So Adonko Group, a multinational corporation and a market leader in the jewelry manufacturing industry. So one thing too that you must be very careful with, especially with PE and transfer pricing, is that anytime they mention what the people do, I want you to underline it or write it somewhere, because that in PE, when you see something like jewelry manufacturing, it tells you that that is the business of the enterprise. Can you see that? It means that is the core what? Business. And the core business means that this is what can create a PE. So if I go to another country and I start doing jewelry manufacturing there, it has created a PE. That is a trigger. But if you are doing something else apart from this, it can be preparatory or auxiliary in nature. That's one trick. Also, when you see this multinational corporation, it tells you there's a group. Definitely transfer pricing issues are coming in, or you can think about a subsidiary PE. PE and transfer pricing, they go together. And then when you see manufacturing, what is that? Is that not a function? Is that not a function?
Yeah.
And what do you use to do manufacturing? Is it not manufacturing assets, production, equipment, and those things, those are assets. Anybody who does manufacturing will face some risk. What risk can you face when you manufacture? Inventory obsolescence, right? If it's coming from outside, foreign exchange risk, theft of those goods, customers may not pay you,
defect.
product defects, accidents. These are all risks. So you see right now we've done a functional analysis. That's all. It's very easy. It doesn't need to really be in the question. Do you see the thing? Good. All right. So jewelries are subject to theft. The workers themselves may steal some.
Yeah.
You see how I related it to the case. Good. So it says what? In the jewelry manufacturing industry, they have their parent company, Adonko Corporation, based in Ghana. So we've seen that they are a group. Anytime you see a group, start thinking about what? Subsidiary PE, start thinking about what? Transfer pricing. So they historically, Adonko Corp in Ghana was responsible for several key functions within the group. These included research and development, right? So R&D is a function encompassing the ownership of intellectual property generated by the group. This thing alone poses a transfer pricing risk. True or false? Performing several key functions within the group can create transfer pricing what? Risk. I told you anytime there are intra-group transactions, doesn't it create transfer pricing risk? Or transfer pricing audit is a trigger, right? So Adonko Corporation handled the manufacturing of all the jewelry products for global sales. Furthermore, the parent company was responsible for marketing, which involved preparing promotional materials for its subsidiaries, right? So there are transactions between them, control transaction between them. So I do manufacturing for everybody in the group. It means I will charge them money. No, so the parent also does marketing and prepare promotional materials for the subsidiary. He will also charge us money. So these things are intra-group transactions. They warrant transfer pricing audit. Does it make sense? The company also provided technical expertise to various subsidiaries. Another service being provided to subsidiaries can be a trigger. Finally, they manage the sales of finished products within Ghana and directly to their 5 subsidiaries located in different countries. So he also manages the sales of the product. Another trigger. Can you see that? So anytime you see intra-group activities, Ankasana, it creates a transfer pricing audit scenario. Hello? So the corporate tax applicable in Ghana is 25%. Okay, so let's look at their recent business transformation activities. 1, a new subsidiary named Subdinco was incorporated in the Netherlands. This entity was assigned the responsibility for all the manufacturing activities for the entire Adonko group. Consequently, Subdinco now sells the finished jewelry to Bonnie Corp and the other 5 other groups within the group. Is there a transfer pricing trigger? Transfer pricing audit trigger?
Yes.
Yes. So selling the finished products to Bonnie Corp. I get it. So also there's transferred what? The intellectual property to Subdinco. Transferring intangible assets to what? A subsidiary. Does it create a transfer pricing audit risk? Yes, it does.
Yes.
3, interest-free funding for Subdinco. You see how you identify it from the scenario? Giving interest-free funding to your subsidiary. Normally, banks, would they give you loan for free?
No.
So if you are giving it for free to somebody, does it meet the arm's length principle?
Arm's length.
No.
So does it trigger transfer pricing audit?
Yes, it does.
Yes.
Yeah.
Is this thing difficult? Relocation of key operational staff. Now, as part of the restructuring, a select number of employees from various departments within Adonko Corporation were relocated to Netherlands to work directly for Subdinco. These departments including manufacturing, research, global marketing, and technical support. Who can tell me what is happening here? Is there a transfer pricing risk here? And why? Who can tell me what is the likely risk here and why is there a risk?
So there's a business restructuring ongoing, and that poses a risk.
Thank you. Thank you. I like that. So they also closed manufacturing operations in Ghana after they established Subdinco's manufacturing capabilities. So Adonko Corporation in Ghana now sees its own manufacturing operations. And this resulted in shutting down the manufacturing plant in Ghana. And most of the associated plants were subsequently scrapped. That means they were sold at a lower value. To whom? That means that this sale or transfer of equipment to can pose a risk. No be so. No organizational structure after the transformation. Despite these significant operational changes, Adonko senior management team and the board remain based in Ghana and continue their employment in Adonko Corp. So was the entity actually closed down?
No.
So you see, it was all group brouhaha that was going on. So they incurred substantial staff redundancy costs as a direct consequence of the restructuring, leading to a significant financial loss in Ghana during the first year following the transformation. So they just wanted to make losses on their accounts. So after the restructuring, they are now classified within the Adonko group as a low-risk distributor of their finished jewelry products. In contrast, Sabdinko in the Netherlands experienced significant profit in the first year of operation. The corporate income tax rate in Netherlands is 15%, which is notably lower than 25% in Ghana. So what were they doing?
Profit shift.
Base erosion and profit shifting. They were shifting profits from Ghana to Netherlands. Can you see that?
Yeah.
This is a trigger for transfer pricing audit.
A big trigger.
Do you get it? This is international tax. This is how we want you to put your investigative this thing on. Identify key transfer pricing issues and risks that GRE will consider in relation to the business restructuring activities. 14 marks. 14.
For 20 marks.
14. Then the B part has to do with business restructuring, which I'm yet to teach you. Identify 3 forms of business restructuring contemplated by the transfer pricing regulations in Ghana. 6 marks. And we've identified all the issues. You're 14. You're quite a baby. Now I'm now come to teach you business restructuring. So let's go and look at business restructuring. Gradually, you can go. And as a go anymore. And I buy kakra ebe ye ebe console. My backing vocalist.
In fact, people are calling me your PA.
Okay, so let's look at business restructuring. And they can ask you, I think one night they ask you everything about business restructuring. That was an old question. I've been expecting it for a while, but then they haven't asked. But maybe, who knows, this time they can ask you. So let's look at business restructuring in detail. Now, business restructuring consists of what? The internal reallocation of your functions, your assets, and your risks within a multinational entity group. Do you get that? So you see that per the question we did, some functions were transferred, like the manufacturing, from Adonko to what? Sabdinko. Do you remember?
Yes.
Assets were transferred, employees were transferred, risk were transferred. So was business restructuring going on in the scenario?
Yes.
Was business restructuring going on in the scenario?
Yes, it was.
Yeah. So in the context of international taxation, business restructuring is defined as the cross-border redeployment by a multinational enterprise of their functions, assets, and or the risks. Sometimes you can transfer without the risks. So it may involve what? Cross-border disposal and transfer of intangibles as well. So it may also involve what? Seizing a business model. Like we saw, they're closing down the manufacturing plant in what? Adonko Corporation. Do you remember? Or introducing a globalized business model of the value chain system. So the cross-border redeployment of what? Your functions, assets, and risk is business restructuring. And I said it can involve what? Disposing and transferring intangibles. It may also involve what? Seizing an existing business model or introducing a globalized business model of the entire value chain system. Does that make sense? So the next thing the examiner can ask you is why business restructuring? Okay, why do we do business restructuring? Now, we do business restructuring to maximize synergies and economies of scale, okay? To streamline the nature of the business and ensure resources are allocated effectively, to improve the efficiency of the supply chain, to what? Preserve the profitability or even limit losses in a downturn economy. That's where there's overcapacity situation, and also to take advantage of development of what? Internet-based technologies. So if we know that some new functions are in the US, that is making businesses automatic. We can close down the business in Ghana and now send it to the US to benefit from this. So these are some of what the reasons why restructuring is important, right? The benefits of business restructuring. Now let's look at the other aspects of restructuring. Now, what could be the disadvantage of restructuring? It comes with a lot of transfer pricing risk, and it is expensive to sometimes do. Do you get the idea? Does that make sense? So let's look at the type of restructuring that we have. So we are going to look at the three most important one. So you see, we have the first type of restructuring, which is what we call transitioning from a full-fledged manufacturing. So let me just go simple. In actual sense, in the past, if you want to manufacture something, you can manufacture it yourself with all your machines and everything yourself. True or false? True or false? But now in the modern era, you don't really need to manufacture everything yourself. You can only manufacture a part and outsource some to somebody. True or false?
True.
In the past, let's look at fufu. Do you remember that in the past, ube ye fufu awa na ube wana waka meboa. But now, because of fufu machine, what do you do? To me boss then some people boss then they just send it to the fufu mill. Meboa. Then they do it for them. Then they come and dress it and pour soup. So they have transitioned from a full-fledged manufacturing structure to either a toll manufacturing arrangement or a contract manufacturing arrangement. This is the thing. You have been doing it at home. It's not exam. Do you understand? These things are things you do every day, but you just don't pay attention to them. So let's understand transitioning from a full-fledged manufacturing, which is a traditional restructuring, to a toll or contract manufacturing agreement. Now, the first approach to what business restructuring in transfer pricing would involve transitioning from a full-fledged manufacturing to either a toll or contract manufacturing agreement. So what is a toll manufacturing setup? Now, toll manufacturing means that the manufacturer utilizes materials that are owned by the principal to produce the goods, owning fixed assets and employing its own workforce. The manufacturer assumes limited risk and charges what we call a tolling fee, while the manufactured goods belong to the principal. What does it mean? You see where you go and grind the corn mill. Let me ask you, the materials that you send, the corn, does it belong to you or it belongs to the corn mill people?
Belongs to you.
It belongs to you, the principal, right? Good. So you own the fixed assets, and then you what? You own the what do we call it? The goods. Are you getting it? But the fixed assets and the employees belong to who?
The corn mill.
The corn mill. By the end of the day, you only pay them a tolling fee, right, for milling the corn for you. Then you go home and go and use it to do your own banku. That's what we call a toll manufacturing setup. Are we okay? I'm coming right now. Oh, why is this thing? I'm coming right now. Give me some 10 minutes right now. I'm coming.
Hello? Hello? Eh, why, am I out or what?
No, you are not out. Prof said we should give him 10 minutes.
Oh, okay.
So I'm back. I hope you can see my screen now. All right. Okay. Please, can you hear me?
Yes, sir.
So what did I say? What is a toll manufacturing agreement before we continue, or toll manufacturing setup?
It's
So
like
it's a business restructuring arrangement where a principal gives his assets or his goods to a toll manufacturer. So another person who will here be an agent, pay the agent a towing fee for the person to process the goods and give it back to the principal as the final product.
So who now owns the assets and the employees to do that manufacturing?
The assets and the employees are owned by the toll manufacturer, like
Thank
the
you. And I
agent.
said, remember the corn mill. The corn mill is a toll manufacturing setup, right? So you send
And
your
then we
corn
pay
there.
them.
Yes, you pay them a tolling fee. They will use their machine, which is the corn, the miller, right? Or the mill. And then they use their own stuff to produce your moray for you. Then you take it home. Do you get the idea? Then whatever you want to go and use it for, that's what we call tool manufacturing. Then we have contract manufacturing. Now, the contract manufacturing, the contract manufacturer, are you getting? We use his own material, his own fixed asset, his own stuff. Then you will now go and what? You will now give him how you want the product to look like. And then you go and take it. Those who make cake, the materials they use to make the cake, is it for you? The material they use to make the cake, is it for you?
No.
The oven, is it for you?
No.
The stuff, are they for you? They are not for you. But all you do is that I want the cake to have my name. I want it to have this design. I want it to be blue. Oh, I don't want icing. I don't want this. Then once it's done, you just pay. That is what we call contract manufacturing scenario. So contract manufacturing, you just tell the the specific features or the type of what specifications you want. They will use their own materials, labor, and assets to produce it. Are you getting it? Once they do
Sir,
that,
can delay Sadi be example?
you said what?
Can delay sardine be an example?
Okay, how does it work? I know delayed sardine, but I don't know how their process works.
She sends her features, how she wants the product to be, then label, the name and everything. So they manufacture and she import it to Ghana as if it's
Yes,
her
that's
product.
what we do now. Even most of my products, some of them that I sell, I used to sell. The Chinese make them, like my custom pen drives I used to sell with my videos. So I give them the specification with my logo, my banner, everything. So they do everything, the pen drive, the style it will look like, the casing and everything. Then they bring it here. Then I now put my videos on it and sell to my students. That's a contract manufacturing setup. You get it? So yes, delay sardine, tasty Tom, same idea. Makes sense. I hope you are now getting it. So these examples will make you write it well. So you can move from a full-fledged manufacturing to now this tool manufacturing or contract manufacturing. Are you getting it? So this is what? Moving from full-fledged manufacturing to either tool or contract manufacturing arrangement. Then you now explain contract manufacturing and tool manufacturing. Are we okay? Are we there? That's the first type of business restructuring. Now, can we look at the next type of business restructuring? This one has to do with distribution and not manufacturing. You know, you manufacture and you distribute. So this one is where you are now moving from a full-fledged distribution, your normal distribution, to either what we call a commissionaire arrangement or a split buy-sell distribution system. So the first type of restructuring was moving from what? Transitioning from what?
Full-fledged manufacturing to toll
To
or
either what?
contract
A toll
manufacturing.
manufacturing or what? A contract manufacturing.
Contracts.
Then here you are now moving from what? A full-fledged distribution structure to either what? A commissionaire arrangement or a split buy-sell distribution system. Is it clear? So when we say commissionaire arrangement, we mean that the commissionaire, or what we call the commission agent, will sell goods to customers in his own name, but on behalf of the principal. Are you getting it? Lacking the authority to legally bind the principal. So the customers will maintain their contractual relationship solely with the commissionaire, while risk remain with the principal who primarily earns the profits. Do you get the idea? So look, if I send somebody to go and buy me some art piece, the person doesn't take my name there. He buys the art piece in his own name, brings it and comes to take a commission. That's how a commissioner setup works. So he acts in his own name. Do you understand? Does it make sense? Does it make sense?
Yes.
Yeah.
Good. But then when we say a split buy sell distribution system, you see the guys who have been doing Yango, Bolt, and the rest. Some of them work like this. So they will now come and take the good for you from you, go and give it to the other person and charge a fee for distributing it to that person. Some people too can distribute something, right? They will buy the thing from you, add some profit margin, and then sell it to that person with their fee. Meboa. So imagine
Affiliate
that
marketing.
I go and take wache from a wache joint, about 20 pieces. Then I add my own to it before I give to people at my office. Most of you have been doing it, right? That's what we call split buy sell distribution. Why na ebida? Wono koto wache 10 CD, 10 CD, 10 CD. Then you buy all cost 30 CD. Then you put 5 CD, 5 CD, 5 CD on all. Then you go and give it to your friends at the office. So each person pays 35, 35, 35. Who has done some before? Most of you have done some before. They are quiet. Or your friends are on the call. Don't be shy. Don't be emotional. Who has done some before? Who has done some before? Who has done some before? But I hope it makes sense. So so look at it. So in simple terms, you see, under normal circumstances, you have to do the distribution yourself, right? But what you do is that you would rather get a low inventory company, okay? They will now bring the goods, let's say from China. Then you will now take it, add your portion, and redistribute it as your own goods that you are distributing, right? So a low tax inventory company will hold the finished goods. They'll transfer the title to the straight buy sell distributor just before sale to the customer. So the straight buy sell distributor doesn't hold any inventory. He doesn't have any inventory cost, right? Or no, on store the goods. He will just come and take it, add his percentage, and transfer it. DHL, FedEx, they add, most of them, they act like split buy sell, right? They just add their portion and then they sell it to the person. So you can either move a commissioner setup where the person will sell the goods to the person in his own name. Are you getting it? You just pay him his commission. And this one, the goods, you distribute them, but you use a low inventory person to rather hold the stock. Then you now take the stock and add a percentage before you what? You sell to the person. So that those are the two types of distribution structures you can move to. So somebody should now tell me the two business restructuring arrangements we have seen before we move to the last one. Yes, faster,
We have
because from here.
restructuring of a full-fledged manufacturing structure to a toll or contract manufacturing structure.
Okay, good.
Then we have restructuring of a full-fledged distribution structure to commissioner arrangement or a straight buy-sell distribution system.
And I hope you can explain them. Good. The same
Yes,
way
yes.
we can transfer intangible properties to a central entity within the group. And then that central entity will now allocate what? The DEMPI, or the rights of exploitation, to people within the group. That's also another one. Then the last one is where we concentrate functions, are you getting it, in a regional or central entity by having a corresponding reduction in the scope or scale of functions in another entity. This is what it means. Just like they closed down what? The other one, what was the name? Adonco Corporation. Do you remember? Then they will send all the manufacturing to what? A central entity, which was Subdinco. By reducing the scope of activities and functions performed locally by what? Adonco. This is the concentration of functions in a regional or central entity that is accompanied by a corresponding reduction in the scope or scale of functions performed locally. So how many types of business restructuring arrangements have we seen? How many? 4. Meboa. 4 Meboana. Transitioning from full-fledged manufacturing to what? Contract or toll. We saw what? Distribution, moving from what? The full-fledged
Concessional
distribution
or
to what?
buy-sell
Commissioner arrangement,
splits.
or what? Split buy-sell distribution. Transferring intangible properties to a central entity, and also
So
concentration
3.
of functions. And also concentration of functions in a regional or central entity. And also with a corresponding reduction in the scope or scale. 4. Subdinco. It says identify key transfer pricing issues and risks that GRA should consider in relation to the business restructuring. We got this, right? 14. Now look at the B part. Analyze the 3 different forms of business restructure as contemplated by the transfer pricing regulations in Ghana. You can suggest the 3, right? What are the 3? There are 4. But what 3 can we suggest?
So please, the intangible part, I didn't get it.
You are transferring intangibles to a central entity to manage it. So the DEMPI functions are being transferred. So let's say I have a patent. Then I transfer the patent to my parent entity. I get, let's say that there was a patent, maybe a patent for the manufacturing, right? But we transferred that patent for manufacturing to Subdinco. And Subdinco is now the one exploiting it for manufacturing to the entire group, or transferring the R&D to another person. Are you getting it? That's an example of restructuring, because we said we are transferring functions, assets, and risks across the group. Is it clear?
Yeah. What about the second one? There are 2.
Which second one?
The first point and the second point. The first point, is that not what you explained?
Yeah, that's transferring of intangible properties. The next one is where you concentrate functions in a regional or central entity. Do you understand? Where it's like you are robbing Peter to pay Paul. So let's say that here, okay, in this your house, we have people who cook food. Do you get it? And people who distribute the food. Then you decided that now you have set up a new house closer to your customers. So the people in this house will only cook food. Then the rest in the other house will now distribute the food. So you have split the functions among the group members rather than it being done at a central entity alone. So the core functions, no, a bigger one, then the small functions, you give it to the other legs. Does it make sense?
Yes.
So a typical example of restructuring will be that I had one branch, right, where I was teaching every course. But now I set up so many branches and I started leaving the courses for other people to teach. Do you get it? So the core courses, which are my concentration, which are my core competence, like international taxation, I teach it myself. Do you get it? Then the other courses, I will give it to other people. That's an example of concentrating the functions in a central entity, which will be accompanied by what? A corresponding reduction in the scope or scale of functions performed what? Locally. Does it make sense?
Yeah.
These things, you do them all the time, but just say, because it looks more examine, no. Nah, afede exami, right? We don't want it to examine. Okay, so you understand now. That's business restructuring. Yay. So we are working our way up. So can we go and look at cost contribution arrangements? Are you sure? Are you ready for CCAs?
Yes, Prof.
Yes, please. Do you have a question for me? Are we ready for CCAs? So it's yeah, transfer pricing risk. Yeah, transfer pricing documentation. Yeah, business restructuring. CCA. Can we do CCA?
Yes, we can.
That is what I'm asking. CCA, where are you? CCA, where are you? All right, so come in. Good. So I explained CCA when we started, right? And I said no contribution, no
chop.
No chop. So no contribution, no chop is CCA. Okay. So we have to understand cost contribution arrangement. Are you getting it? The same way we are sharing the cost, when some profit come, don't we share? The same way we are sharing the cost, profits come, we no go share.
Yes,
sir.
We go share, right? So let's look at cost contribution arrangement. Now, a cost contribution arrangement is an arrangement among related parties within a group where the participants jointly share costs and risks in exchange for a proportionate stake in the anticipated benefit. So we work to cook that food because we know that it will satisfy our hunger. That's cost contribution arrangement. So this arrangement can serve various purposes, including acquisition or development of intangible assets or the provision of intra-group services. So crucially, these CCAs entail equitable sharing of contributions among the participants to adhere to the arm's length principle and prevent profit shifting within the group. So whether contracted between dependent or independent parties, the CCAs require what? Participants to have a reasonable expectation of the benefit, distinguishing them from mere service providers whose sole responsibility is performing activities under the arrangement. For now, whatever I've said, don't understand it and won't hear me. But what I want you to hear you, or the thing that I wanted to hear you, is how people jointly share costs and therefore they want a stake in the anticipated benefit. Does it make sense? That's CCA. Because my boka, I am expecting a benefit. That's why I bought the car. Is it clear? Is it clear?
Yeah.
That boy spending money on that girl knows that there's a benefit. That's why he's spending the money. It's cost contribution arrangement. You understand?
Yes.
Makes sense. Good.
Yeah.
So what are the types of CCAs that we have? We have two types. We have what we call development CCAs and we have service CCAs. Now, development CCAs mostly comes in the form of DEMPI. Okay, so when you are developing intangible assets, let's say there's a software you are coming up with. You are the one who installed the algorithm, did the development, went to do all the research and all that. It becomes a development CCA. So if most of us are doing it and each of us brings some particular percentages, then when benefits are coming, we have to share in it. Do you understand? Service CCA, we come and we decide to what? Let's say that there's this foreign client, right, who wants a complete business service. I'm an accountant, right? Maybe you're an AI specialist. Maybe Ruhema is maybe a digital marketing specialist. Another person is maybe an IT maybe risk specialists, forensic specialists. All of us come together, right? Contribute costs. We do the service according to what we are supposed to do. Then we share in the benefits when it comes. Do you get it? So we'll have an appropriate profit splitting mechanism based on the nature of the arrangement. So an appropriate transfer pricing method will be chosen. So for development CCAs, we can use something like the cap method, or we can use profit split. Service CCAs mostly we can use cost plus or even transactional net margin method, selecting a net markup as the profit level indicator or the financial indicator. Anyway, don't worry about that. When we get to the methods, you understand it very well. Okay, so let's look at development CCAs. Now, development CCAs are established for joint efforts in developing tangible or intangible assets, right? Aiming to generate ongoing benefits for the participants, despite the associated uncertainties and risks. I get once you contribute cost, you know that there are some risks that are going to come. Despite the risk, you also want a share in the anticipated benefits. Now, each participant typically gains a right in the developed asset, whether through legal ownership or certain usage rights, with obligations to contribute proportional to the expected benefits. Does it make sense? Did you get development CCAs? So 2 or more people come together to develop a project. Either it's a tangible asset, a building, or it can be an intangible asset, a patent or a copyright or something. Does that make sense? Or a software? Make sense.
Yeah.
Good. So let's look at service CCA. Now, service CCA, on the other hand, focuses on sharing the costs and benefits of obtaining services, providing a more immediate and predictable advantages. So such arrangements outline the services each participant is entitled to receive, right? Facilitating streamlined payment based on aggregated benefits and costs, thereby promoting efficiency and risk sharing among the parties. Where?
Someone's hand is up.
Someone's hand is up. Someone, they said your hand is up. Who is someone? Please.
Yes, sir. Yes, sir. Yes, sir. So I wanted to say, so can we say that this petroleum agreement that the contractors come into, can it fall under the development CC?
No, please, can you amplify your voice?
Yeah, so I'm asking the contractors, the contract they come into with the government of Ghana, can it fall under the development CC?
Yes, that's a typical example. So even in transfer pricing arrangement, that's how we deal with it. Okay. But then, because CIT doesn't really examine you on the transfer pricing bits of oil and gas, I get it, but it's the foundations. But in real life, that's how we do it. So there's that transfer pricing aspect. Yes, so it's a development CCA.
Okay.
All right. Do you understand? So those are the 2 types. So why should we have CCAs? So they offer several advantages, like economies of scale. I mean, if we come together, right, the 2 shall attain many, right? Reduce cost compared to individual in-house services. If we are doing it alone, it will be more expensive. We can have financial synergies, minimize functional duplication within the group, and shared risk among the participants, right? Services covered under CCAs will come from various domains like management, technical services. We can do marketing and legal services. I get it, which may bring versatility and applicability across different operational aspects within the group, right? But anytime you are looking at CCAs, they must have at least 2 participants, right? The sharing of costs between the participants should be based on the anticipated benefits. The participants should have a reasonable expectation of benefiting from taking part in the arrangement. And the details of the arrangement must be documented. So the form of the CCA and the economic substance should be consistent. Arrangement should be should exist for the departure of participants. You remember the buyout and buy-in payment I was mentioning? That you are cooking the food, that then one person's mother will come and call him. Then you have to compensate that person. You remember? And also if somebody sees that the food is nice or he's smelling the aroma from outside, he wants to join. You must. So these things are all features of CCA. One person cannot do a CCA. That's why it's a cost sharing. So there must be at least 2 participants. I get it. So the sharing must also be based on the benefit that they want to get. They should have a reasonable expectation of getting a benefit from if they take the arrangement, and it must be in document or it must be in written form. It must be documented. The form and the substance should be consistent. I get it. And then there should be arrangement that exists for new participants who want to join and those who are going out in terms of balancing payments. So if people want to participate in a CCA, first there must be mutual benefit. So we know that we are all getting some benefit, right? From the CCA, there must be control. We must have functional capacity to exercise control over the risks that are taken in the CCA. The CCA should bring what value? It should be valuable. We should expect some sort of benefit. Are you getting it? I get it based on the value of our contributions. So the CCA and the arm's length principle. Now, to determine if the CCA measures with the arm's length rule, it is important to measure the value of each participant's contribution to the arrangement. Now, under the arm's length rule, the value of each participant's contribution should be consistent with the value that independent enterprises in comparable circumstances would have assigned to that contribution. Do you get it? So if you are doing this CCA and people on the market will do the same CCA, but they will charge prices of 240,000, and you are charging 350,000. It means you have deviated from the arm's length principle, right? The commissioner will pass an adjustment of that 90,000, that 110,000 back to your profit. Do you understand? So that's how CCAs work. CCA is going. Is it gone? Is it gone?
Sir, please, can you explain the service CCA last, like one more time for me?
People coming together to incur costs to give services to somebody and then enjoy the benefits that come from the services if they are paid. That is all.
I want an example.
I gave an example. Okay, you go into a beauty salon, right? There's somebody who does nails and trimming. There's somebody who fixes wig. There's somebody who does makeup. All these people do this service for you, right? But no set business up or that arrangement to come and meet you. Now, after you pay them, don't they share? That's service CCA.
Okay.
$10,000 going, it's gone. What are balancing payments? I told you there are two balancing payments in CCA. What are they?
The buying and buying.
Buyout and buy-in.
What is buy-in?
When you are not part of the initial agreement, but we want to
coming to join.
perform eventually.
And what is buyout? When you want to leave, they must compensate.
Yeah, where you are already
Like farming out.
Okay.
Ish.
So CCA, is it going? It's gone. Okay. So now CCA is gone.
The last one. What about the one that you said that if somebody wants to join, like Obi no Edianina say it is the aroma is
That's the buying.
That's what I said, the balancing payment.
That's
So
the
balancing payment. Either you want to join to balance the CCA or you want to leave to balance the CCA. If you want to join, there's buy-in payment. If you want to go out, there's buy-out payment. Okay. Now, another way group members do their transfer price is through financing arrangement. So when it comes to financing arrangement, we can still relate it to think capitalization, but I'll come and treat think capitalization tomorrow. Okay, I'll treat think capitalization tomorrow. But then, when it comes to financing arrangement, the simple thing is that you see, group members can give loans to themselves or guarantees. Are you getting it? Or service fees, whatever. But so far as it relates to financing, is it at arm's length? That's the problem. Are you getting it? So the transfer pricing regulations also determine criteria for determining arm's length in financial arrangement between associated enterprises. Now, when the interest or loan fees are not charged or the charges are not consistent with the arm's length standard, the Commissioner General now has the authority to deem appropriate interest or adjust the fees to reflect what an independent party will charge for those arrangements. Does that make sense?
Yes.
Yeah, so if you have given a loan within the group, then the commissioner can say, you know something, what you are doing, I don't think is in line with the arm's length standard. So I'm going to adjust it to reflect the arm's length standard. Now, to assess whether the interest or fees aligns with the arm's length standard, the commissioner uses several factors, like the loan's characteristics. Okay, so if we have to look at the loan, does it look like a real loan? So we look at the purpose of the loan, the amount, how long will it take you to pay? Does it have security on the loan? So these things are also used to look at the commerciality of the loan, whether it looks like a normal corporate loan. If it does look like a normal corporate loan, we'll allow you. But if it looks more like equity, that means that you are trying to cheat the system. So the borrower's credit risk profile, prevailing economic conditions, we can look at all these things and any other relevant information to determine whether the loan itself looks like what a normal bank would give. So if it looks like what a normal bank would give and the interest rate looks reasonable, we will allow you to deduct it from the group. Otherwise, you are doing base erosion and profit shifting. What do I mean? Assuming I transfer loan, look at this. I transfer loan from my company in what? Mauritius. Are you getting it? To a company in Ghana. Mauritius is paying tax at 5%. Okay. Now, the company in Ghana, a loan, according to Section 10, the interest on that loan is an allowable deduction. Okay. So I can deduct it from my profit. So that loan in Ghana, I pay tax of 25%. If I make profit of 1 million and the loan interest is 1 million, I've made a loss, right? Do you get it? But then that payment will be paid to the company in Mauritius. That means you are manipulating interest rates and the loan to take advantage of these rules. Do you get the idea? So the commissioner would make sure it looks like what independent parties will do and whether you meet these criteria. So the regulations also address financial guarantees. So if you provide a financial guarantee for somebody within controlled relationships, if you stipulate that the guarantee fee should reflect what an independent party will pay for such a guarantee. Do you get it? So always the commissioner makes sure that whatever you are doing is in line with what independent parties will do. Just because I don't want to waste time, straightforward, I want us to do thing capitalization and how it relates to financial arrangement. So what is thing capitalization? So the word capitalization represents the market value of equity. Okay. So on your financial statement, you have two sources of finance. You have debt and then you have what? Equity. Is that okay? And equity is the same as your capitalization. So if they say thin capitalization, it means what? Your debt is fat. If equity is thin, it means your debt is what? If equity is thin, it means your debt is what?
Fat.
It's fat. So fat debt is the same as thin capitalization or thin equity. It's the same as high gearing. So when companies have a lot of what? Debt in their capital structure, it means that they are highly geared. That's what creates thin capitalization. Why is high gearing a concern to the tax authorities? Because more loans mean more interest, and more interest means less tax. Because interest has a tax shield, it reduces profit. Do you get the idea?
Yes.
Good. So that is what creates thin capitalization rules. That is thin capitalization, but we have an anti-avoidance rule, which is thin capitalization what rules. So thin capitalization in Ghana. So thin cap is also an alternative to the arm's length principle. If you don't know, I'm telling you. So if they ask you several alternatives, I can give you what the other one. So there are other ones like earnings stripping as an alternative. We have what we call limit to interest approach. Limit to interest is another think up approach, but Ghana, we don't use limit to interest approach. We use a fixed ratio and the arm's length approach. We have the global formulary apportionment and so on and so forth. So these are the common ones. Now, I want us to look at think capitalization in Ghana. Okay, because we are in Ghana, basically they are not going to ask you that. So think capitalization in Ghana. So Ghana, most people only look think capitalization from section 33. But think capitalization, we can look at it in three. There are 4 types, but I'll only restrict you to 3 types of think capitalization in Ghana. All right. So in Ghana, think capitalization can utilize what we call the arm's length rule. And we are going to dive into what the arm's length rule for think cap relates to. And then this can be found under section 31 and regulation 15 subs regulation 2 of LI 2412. Okay. Then we have the fixed ratio rule, which is what people know as think cap. So that's a fixed ratio rule think cap, which can be found under section 33 of the Income Tax Act. Okay, so that's the fixed ratio rule for think cap, which can be found under section 33. And then we have the hidden profits rule. So the hidden profit rule can be found under section 34, section 99 of the Revenue Administration Act. Okay, so those ones are general anti-avoidance rules for hidden profits. Okay, so there are so many legs to some of these anti-avoidance provisions in our law, but these are common ones that I want you to do. So you can put this down quickly. I'm going to go through all of them using the Income Tax Act for us to understand it detailed, right? So once we understand thing capitalization, we'll come and talk about all of them, see how it is applied, do a proper question, take a proper past question that has come before, and look at ways to bypass thing capitalization, right? So what are some of the ways to bypass ThinkUp? Okay, so there are so many ways to bypass ThinkUp. I'll give you some of the ways, and then I know ThinkUp is gone. And it is actually an anti-avoidance provision, thing that stop people from taking advantage. So the loophole is that interest, right? We can deduct interest, but ThinkUp limits the amount of interest deduction, which means that it becomes an anti-avoidance. Antivirus stop virus. Anti-avoidance stops tax avoidance or tax planning. Do you get the idea? So please write this down quickly, and then let's go them one by one, take a question to understand how they work, go into the regulations, and then the Income Tax Act. Then we'll come and now look at how to deal with intangibles in transfer pricing and how to deal with intra-group services. Before we look at transfer pricing reports, the methods, and then the arm's length principle, then we are done with all of transfer pricing for your exam in one day. All right, so continue. Right, are you there? Are we home?
Yes.
Yes.
Good. So let's go to section 31 of the Income Tax Act. That's where we actually find the arm's length principle, right? But then there's something interesting there apart from the arm's length principle. Okay, so let's go and look at the Income Tax Act. Income Tax Act, where are you? Income Tax Act, where are you? I'm coming. I'm looking for the Income Tax Act. Relax. But so far, so good. Have we learned something on transfer pricing?
Yes.
So I started with the confusing parts, okay? What we have actually done are the confusing parts of transfer pricing. I mean, we are now going to the easy areas. So let's go to section 31. Okay. Section 31. Can you see my screen? Okay, so arm's length standard and arrangement between associates. So where an arrangement exists between persons who are in controlled relationship, okay, the person shall calculate their income and tax payable in accordance with the arm's length standard or the arm's length principle. So this is where the arm's length principle is defined in our law. Is that okay? We can find it under section 31 and regulation 2 of the transfer pricing regulations. Now, the arm's length standard is actually a standard which requires persons who are in a controlled relationship. I said which requires persons who are in a what? In a controlled relationship. This is what in your case or the transfer pricing rules, it is known as associated persons or associated enterprises. Do you understand? Now we saw the word persons in what? Controlled relationship. It means related parties. Now, these are the persons who are related. In our law, when we visit section 128, it tells us persons who are in a controlled relationship. One, relatives. So if you are relatives with somebody, okay, you and your wife, your children, your uncles, nieces, all those things are considered relatives in our law too. If you are partners in the same partnership, you are considered persons in controlled relationship. If it's a trust relationship, right? So relationship between the trustee, the beneficiary, and then the settler, are you getting it? Are all considered to be in a trust relationship. Then we have what? A person and a company, right? Where the person controls at least 25% of the voting rights or 25% of the shares in the company. A PE and its head office, right? A PA and its owner are also in controlled relationship. They are related parties. Then a principal and an agent, somebody who carries out activities on your behalf. you and him are considered to be what? In a controlled relationship. So this is what section 128 says. So I'm more interested in the company. So if you own at least 25% of any company in Ghana, then both of you are considered to be related parties. Does that make sense?
Yes, Prof.
So
Yes.
anytime you see
Please,
group,
is it 50% or 25?
it was amended in June 2023 with Act 1094. It is 50%. It was 50%
okay.
for that amendment. Is that okay? Is that okay?
Okay, thank you.
So now it's 25%. So
Yes,
far as you
please.
see a group or you see a company which you own 25%, meaning that you are what? You are in what? You are in controlled relationship. Do you understand? Or you are associated enterprises. So any transaction between them should be at the arm's length principle. So the arm's length standard is saying that so far as persons are in a controlled relationship, meaning they are relatives, they are partners in a partnership, they are in a trust relationship, or you own 25% or more of that entity, or it's a PE and its owner, a principal, and an agent who carries out activities on his behalf. Those people, the commissioner said that any amount they are going to deduct or include in their income should reflect an arrangement that would have been made between independent persons. So everything about transfer pricing is asking yourself that somebody I don't know, will he do the same thing? Do you understand? That's the whole thing about the arm's length standard. And they are saying that the minister will make what? An LI to what? Make matters I get on transfer pricing and how to apply the arm's length standard. And that's the transfer pricing regulations. Now, this is where I'm concerned about the subsection 4 and subsection 5. Look at what it says. I get it. It says, where in the opinion of the commissioner, a person has failed to comply with subsection 1, that's the arm's length standard, the commissioner may make adjustment to be consistent with the subsection 2. Okay? That means he will make what? Arrangements to make it look like what independent parties would have done. So that means anytime you deviate from the arm's length standard, the commission will make adjustments to make it reflect the arm's length standard. What type of transfer pricing adjustment is this?
Primary.
Primary. Thank you. Oh. Mama minyaje pa. Do you understand? It's a primary adjustment. Thank you. Now listen carefully. You see this adjustment that the commissioner has done here. It has thing capitalization hidden in it. For instance, if every bank in Ghana is giving a loan at 20% and you alone you are giving loan at 60%, does it reflect what independent banks are doing? Does it reflect what independent banks are doing? No. So there's a hidden profit. Do you get the idea? So where you have failed to apply what the individuals are doing or the independent parties are doing, the commissioner shall make adjustments to make it look like the arrangement would have been made between independent parties. So he's going to disallow 40% of the interest, right? And then you're going to pay penalties because you have deviated from the arm's length principle. So this is the arm's length in capitalization. Also, in carrying out this adjustment that we have seen, okay, the commissioner may recharacterize an arrangement I get made between persons who are in a controlled relationship, including recharacterizing debt financing as what? Debt financing as what?
Equity.
So this is also another aspect of the arm's length in capitalization. It means that maybe you have charged a loan, okay, of 100 million in your books with interest of 10%. That means you would have paid what? Interest of what? 10 million, right? Good. Now, this 10 million interest, you are happy, but the commission will say it and say, hold up. This 10 million, I won't accept it. This 100 million, cry, doesn't look like a loan. I want 60% to be equity. So that means that if the commissioner is telling you that this 100 million loan on J and 60 million should be equity, that means only 40 million of the loan should be debt, right? So it means that 60% of the interest should also be disallowed for tax purposes, meaning that 6,000 or 6 million of that interest should be disallowed. It will now be equity. So it will now be treated as dividend instead of interest, subject to 8% withholding tax. Do you get it? And the commissioner will look at various things before he said that, no, this thing, I think that it looks more like equity rather than debt. So in that case, change this debt to equity. Do you get it?
Prof, can you give us a practical example?
It's a practical example I'm giving you. What practical example
The
again?
things that the commissioner will look and say, I'm converting loan into equity.
Don't worry, I will come there. But do you understand what I said?
Yes.
Good. You see those things we're talking about when we're talking about the financial arrangement, like the purpose of the loan, whether it
The
looks like what
interest
a
rate.
normal corporate creditor will give. Do you remember those things?
Yes.
Yeah.
Those are the same thing the commissioner will look at before he can say that this loan I would, and he
Okay.
during a transfer pricing audit. You remember the transfer pricing audit?
Yeah.
You remember the transfer pricing audit?
Yeah.
So if the commissioner is doing the transfer pricing audit, he is going to look at all those things and say that, you know something, I have examined your transactions and I feel like what you are doing, are you getting it? It doesn't look more like debt, but it looks more like equity. So let's go to regulation 15, sub-regulation 2 of the transfer pricing regulations, and let's see. I know some people will not take this thing seriously until they go and meet it before they will shine their eye. That's the thing. No, yeah, some. Hmm. Well. I'm coming. It's loading. Hold on. But do you get the whole idea? Did you understand the arm's length think up? So the commissioner placed two rules there. What are one? The interest itself, he can what make it look like the arm's length. True or false? And two, the arrangement, he can, in doing that adjustment, he can recharacterize debt financing as even equity what? Financing. Do you remember? Do you remember?
Yes. Yes.
So read sub-regulation 2.5 of regulation 15 for me. Read it and let's see. Read for me.
For purposes of subsection 5 of section 31 of the Act, the Commissioner General may recharacterize a debt financing arrangement between persons in a controlled relationship as an equity financing arrangement after considering the following factors. A. The presence or absence of a fixed repayment date. B. Whether there is an obligation to
Whether the debt financing represent or it looks like a loan that a normal bank would give. Can you hear me?
Yeah.
Yes. So one, does it have a fixed repayment date? Normal loans have a fixed repayment date. So if your loan you are giving in the group does not have a fixed repayment date, then it looks like what? Equity. Is there an obligation to pay interest? Normal loans have obligation to pay interest. If yours doesn't have obligation to pay interest, it looks like equity. Should be classified as such. Do you have the rights to enforce payment of principal and interest at any time? Normal loans, the buyer, the owner or the lender can come and say, "Pay me my money." True or false? So, bet me have a dime or car at any time. Meboa na comes with a security. True or false? If you don't have those things, it means that it doesn't look like a loan. If we look at the status of the person giving the loan, does it look like a regular bank or a regular corporate creditor? Do they have financial covenants and security? Can you obtain a loan from an unrelated lender? The extent to which it is used to acquire asset, the opportunity for you to default in repayment on the due date or seek a postponement of the date for repayment of the loan. If every time the date is reaching, you seek postponement, it doesn't look like a loan, looks more like equity. So if the commission looks at all the terms of an arm's length loan and you don't meet these terms, he is now going to pass that adjustment and say, okay, that debt that you have, which is 100 million, it looks more like equity. So therefore, we'll treat it as equity, meaning that the interest that you charge in your account, which was that 10 million, will be disallowed for tax purposes. This is what we call the arm's length thing capitalization rule. Most people are not even aware that a thing capitalization rule like this exists in the Act. So they are not taking advantage of it. All right. So are we okay with that?
Prof, if I may
Yes, please.
ask,
Mm-hmm.
do we have to see all these conditions, or the fact that any of it appears is enough to
No,
recharacterize?
to the commissioner may use any of them, but then he has to go through all of them, because a regular corporate loan, before we even give it out to people, we assess all these things first before we give it to the person. So the commissioner does the same test the banks do before actually checking whether the loan meets the criteria. You get it? But
Okay.
in his opinion, the one that supersedes all is whether you are actually paying interest, and whether they can enforce you to pay, and whether there's a what do we call it? Security and covenants attached to it. Normal loans just have this. So majority of them stands, you get it. But that's the opinion of the commissioner, not you. It's the commissioner who does this during a transfer pricing audit. Do you understand? So good.
Prof, please, what about, so the one that we learned earlier, where he considers the duration of the loan, the credits, those credit worthiness, those interest.
Yes, it's still this thing. Yes, that is what financing arrangement. So if there's any loan within the group, you see, it's still considering these same things. Yes, it's still the same.
Oh, okay.
But that one didn't talk about just interest. But if there's a loan, loan doesn't only come with interest. It comes with other things, processing fees, guarantees, other things. All those things, no, it can be manipulated for group purposes. So the commissioner considers all these things before he allows you to deduct those charges.
So when they ask us in the exams, are they expecting us to write the verbatim, like what is here,
No,
or
not verbatim. But to be to me, what you have, okay, be a throw.
okay.
Prof,
Yes, please.
this is a general one. You could realize that even within a company, especially in the banking sector, recently or last year, GRA said that the interest they were giving to workers in terms of employee loan is too low, and they have to recharacterize those loans again. In that realm, does it have any relation with transfer prices? I know transfer pricing is between associate companies. What about intra-company and its employee relationships?
Okay, so you see, generally giving loans itself has a rule under the fourth schedule. All right. Now, do you know that loans actually for employees must still meet the arm's length principle? We can make reference to section 26, arm's length, right? Quantification according to market value and the fourth schedule. So anytime you give a loan to employees, we still check these things, but we only check a minor aspect. So let's say that you give a loan to an employee, right? We check three things. One, is the loan from the employer to the employee? That's the first condition. Two, is the loan term greater than 12 months? Three, is a loan and any outstanding loan for the previous years greater than 3 months basic salary? These things we are checking are the arm's length rules for a normal loan on the market. So if the loan you borrowed was 10,000 and 3 months basic salary was 5,000, it means that this loan looks more like a normal corporate loan. If the term of the loan is 16 months, it means that it looks like a normal corporate loan. If that is the case, then we find the arm's length interest. So arm's length interest on this loan means that, okay, what will be the statutory rate? So if Bank of Ghana rate is 22% for all loans and you are giving your employees, right? So if the loan was 10,000, then is this 10,000 at 22%, which is how much? That's 2,200, right? So let's say that this 2,200 is how much you should have charged, but you gave your employees at 10%. So that means that at your rate, the employee would have paid 1,000 cedis, right? So this is what you are saying. You are saying that the extra amount that has been paid, I get it, that should have been paid, that is the 1,200, is actually the arm's length adjustment that is actually supposed to be a benefit to you, because the actual benefit is 2,200, you paid only 1,000. This should be the benefit, but for employment income purposes, because the employee, you are the one who actually employed him, we have to be fair to him. So the commissioner said, okay, this arm's length adjustment, I only need a quarter, so I'll now take this 1,200 and just divide by 4 to now come and get what? 300. Now this 300 is what now becomes a loan benefit to add to that employee. So loans that are given to employees, still he tests the arm's length principle. Do you get it? And that's what people don't. So every principal must be quantified according to market value, because GRA on your mommy, on your papa. The only thing GRA can use is what? Fair market values. Is it clear?
Yes.
When you look
yes.
at creation.
Jose?
Yes, yes. Thank you. Very, very clear.
You are welcome. Always welcome. All right. So that is what brought loan benefit in the law. Okay. It's a qualifying non-cash benefit. So when we say qualifying benefit, what does it mean? It means that the tax law has provided for it. Is it clear?
Yes.
Okay. I hope what we've been doing so far makes sense. So we've seen what? Arm's length think up. And I said arm's length think up. We saw it from two phases. The first phase is the manipulation of interest, right? So where people manipulate the interest rate. If interest is what, 20%, and you alone you are charging interest of 40%, the commissioner can adjust it back to profit. Two, the recharacterization of debt to what? Equity. No be so. And there are some conditions that has to be met. So you have to mention the conditions. So that's the arm's length think up. Now let's go to the proper think up, which people know. That's a fixed ratio rule. So let's go and look at the fixed ratio rule. I'll actually take a question to actually teach you how to do the fixed ratio rule. So the fixed ratio rule is one of the most simplest types of think up. And this is what our law knows as think up under section 33, right? So this one is simple. We are saying that, you know something, if you have a related party loan, okay, and that related party loan brought what? Interest and brought a foreign currency instrument or a forex loss. Are you getting it? That loan, if we assess it over our equity and we end up with debt to equity ratio greater than 3:1, that means the allowable ratio, which normally we call this a safe harbor. We'll come and discuss before we close. We'll come and look at what we mean by safe harbors, APA, and the rest, right? But we are saying that 3:1 is what the law allows you, right? But if the loan exceeds more than 3 times the equity, that means any interest and forex loss that came because of that loan will also be limited to the 3:1. Do you get the idea? Do you get the idea? If it
Yes,
doesn't
Prof.
make sense, let's take an illustration. So ABC Group, are you getting it? Offered ABC Ghana, okay? They offered ABC Ghana a loan of $100,000, okay? You remember this example? We did some a few days ago where the exchange rate was $1 is to 10 Ghana cedi, right? On 1st January 2025, okay? On 31st December 2025, the exchange rate now became what? 15 cedi to what? $1, okay? The financial statement has been given below, okay? So we have interest charged, okay? Profit per the account has been given as 4 million, okay? We have interest charged in the account as 100,000, okay? So they've charged interest of 100,000 in the account, okay? So let's say they've charged interest of 100,000 in the account, and then they have also charged, let's say they have charged depreciation of 150,000 in the account. Then capital allowance agreed with GRA. $500,000. Okay, so let's say depreciation 450. Okay. Then they have told us that what on the balance sheet, right? They have what? Stated capital. Stated capital. That's 10,000, right? Then we have retained earnings. Retained earnings of 190,000. Okay. So this is the information we have, and they are asking us that we should recompute the profit, right? So calculate the tax payable of this guy. I just need a tax payable. Okay. So when you look at this itself, right, because of this foreign loan of $100,000, this guy charged 100,000 Ghana cedis in his account as interest, and there'll definitely be a loss, right? So what's the rule? The rule is that you have to ensure that it is within the scope of the 3:1. Are you getting it? So let's see this. That's 3 times your equity. So first of all, how much was the foreign loan? How much was the foreign loan that was acquired?
$100,000.
Okay, it was $100,000. Now let's convert it to local currency. Are you getting it? So if I look at the loan, the foreign loan in the foreign loan account, okay, or the related party loan, the opening balance was what? So we accounted for 100,000 when the exchange rate was what? 10 cedis. True or false? So this gives us 1 million Ghana cedis. Good. Now at the end of the year, that's 31st December, it became what? It's a monetary item. So under IAS 21, we have to retranslate it using the closing rate. Sorry for taking into account. So the closing balance now becomes this same 100,000 now at what? The 15 cedis. True or false? So that means if we want to settle this loan now, we will settle at 1.5 million. True or false?
True.
Good. Now something now the obika 1 million. See how could you 1.5? What boka na when you have you lost or you have gained?
Lost.
You have lost, right? So it leads to a foreign exchange loss. So this foreign exchange loss is an extra what? 500 what? 1,000. Are we okay? So this one is a foreign currency what? Loss, which would have been charged to the account as well. It is because of the loan of 1 million that brought what? 500,000 foreign currency loss. Mebwa. Okay, that's good. Now, the interest on this loan was also how much? It was 100,000 Ghana cedis charged in the account. No be so? Okay, now they said the debt to equity ratio should what? The allowable debt to equity ratio is how much in the law?
3:1.
3:1.
So we only allow 3:1. Anything above 3:1 should be disallowed. Mebwa. Good.
Yes.
So in that case, let's find the debt to equity ratio per the question that they've given us. So first of all, how much was our equity? Now, equity under think up in our law is stated capital plus retained earnings. What did I say?
Stated capital plus retained earnings.
Retained earnings. So it means that if you have any what do we call it? If you have any other reserve like capital surplus or other reserves, ignore them. They are not realistic for tax purposes. What did I say?
Reserves
What
and
did
all.
I say?
Ignore all other reserves
Yes,
because they are
apart
not
from stated
relevant
capital
for
and
tax
retained earnings,
purposes.
all other reserves are ignored. Yes, they are not relevant. They are not real. The only relevant earnings was what? 190,000. If we put all together, what do we get? Get 200 what? Can we see that? So we've gotten the equity, MNCD. True or false? True or false? The loan, was it not 1 million Ghana cedi?
1 million.
Yes, it
When we
was.
converted, was it not 1 million? Don't use the closing, use the one at the start. Was it not 1 million? When we converted at the start of the year? Was it not 1
Yes.
million when we converted?
It
Yes.
was.
And the
Yes.
equity
It
we got
was.
what? 200,000. So we said debt to equity, debt over equity. So 1 million over 200,000 will give us what? 5. True or false?
Yes, please.
Is it not 5? That means our ratio is 5:1. So this is 1. But 5 times of this gave us this one, right? So it's 5:1. Our debt is 5 times the equity. Can you see that? So if our debt is 5 times the equity, dear, what was our allowable debt? The law says that the amount of debt we can deduct is what?
3.
3:1. Mebwa. Yes, so the debt should be 3 is to what?
3
3
times
is to
200.
1. Yes. That's 3 times 200, but that means it's 3 is to what? 1. No be so. So if 5:1 is what we have charged and 3:1 is what is allowed, that means how much should be disallowed?
600 minus 400. Two.
No, I didn't ask for money. I said how much should be disallowed. If 5:1 is the thing and 3:1 should be allowed, how much should be disallowed? Is it not 2:1? Yes. So you are saying that the total was what? 5, mewa. And the what? The allowed was what? 3. That means that disallowed was what? 2. Is that not so?
It's so.
So if I want allowable interest, for instance, how much of the interest should be allowed? Then it should be what? The 3 out of the 5 times the total interest of 100,000. Don't be so?
Yeah.
If I want interest disallowed, I can just what? Take 2 out of the 5 times what? The 100,000. Or just take the total 100,000 and deduct the allowed. Straightforward, right? You realize I've used a different method to teach you think up today. Of course. There are so many things you can do. But this is faster, right? Okay, so in that case, that means allowable interest will be 3 out of 5 times the 100,000, right? So that means that 60,000 of the interest should be what? Allowed. If I want the disallowed, that means it's going to be what? 40,000. Or simply my disallowed interest will become what? Taking the whole interest of 100,000 less than what? The 60,000 that was allowed. That means the 40,000 becomes what? The disallowed portion. You understand? What about the disallowed forex loss? If I want what? Allowed forex loss, it will be how much? Forex loss was 500, right? So if I want the allowed, it will be what? Allowable ratio is 3 out of the 5, the total. So 3 out of the total 5 times the 500,000. And that gives us what? 300,000 as allowed, right? If I want the disallowed what? Forex loss, it will become what? The 500,000 minus what? The 300,000. And that gives me what? 200,000. This is the same as just what? Taking the 2 out of 5 times the same 500, and that still gives us 200,000. So this is how you do think up. Now they said we should compute the tax payable. So when I take my profit before tax, that was given here as 4 million, right? So I take this 4 million, then I add back disallowed deductions. So I'm going to add back all the disallowed. So add back disallowed deductions. So disallowed deductions, what and what did I have? We said there was depreciation, right? So I'll add back my what? My depreciation. So depreciation was how much? 450,000, right? So I'll add back the depreciation of 450,000. I'll add back the interest disallowed. So my interest disallowed was what? 40,000. And then I'll add what? My forex loss disallowed. And that's what? 300,000, right? And that now gives me my adjusted profit. So once I get my adjusted profit, that's 4 million plus 450,000 plus 40,000 plus 300,000, and that's 4,970,000, right?
Hello, Prof.
Yes, please.
The forex disallowed is 200,000.
Yes. Oh, 200. Okay. Yes. So then we get what? So that means it will change our figure. But you get the idea. It's just the idea, right? So 4,690,000, right? So in that case, our capital allowance was given as 500,000. So we take this and then we end up with 190,000. Then we tax at 25%. Then capitalization going is gone. If you have any question, you can ask. If you have any question, you can ask. If you have any question, you can ask, or everybody's fine.
Sir,
Yes, please.
please, would there ever be a case where you have to use 35% for the tax? Well, can there be an incident where international taxation, a question will come from the
A
oil and
petroleum
gas side?
company. Of course, why not?
Yes.
Of course, why not?
Okay.
It can even
Okay,
come from
because
hotel.
right now,
It can even come from hotel where you have to use 22%. It can even come from non-traditional
mm,
expense where you have to use 8%.
mm,
Can come from anywhere. Just that they want to make the thing easy for you guys. Oh. And no crown and kofu complaining. You know.
hmm.
But you don't know. Anyway, that's why we are there for you to make things simple for you. All right. So what are some of the ways you see the law only recognize thing capitalization when you give a loan to a subsidiary or one of your group members. Do you understand? And then if you want to bypass it, there are several ways you can bypass it. One is that you can decide to stick to the allowable debt, right? Stick within the allowable debt rules. You get it? Meaning that your debt will not be more than the 3:1. It will be within. Two, you can do something we call back-to-back thing capitalization. When we say back-to-back thing cap or back-to-back financing, what does it mean? Now, back-to-back financing works like this. Okay, so normally when a loan comes from a bank, okay, the tax authorities allow it fully. They don't limit it to think cap. So assuming the loan came from entity A straight to entity B, okay, and this guy now transfers the interest. This guy gave a loan, right, to this guy, and now he's paying the interest back to this guy. We'll subject it to think cap. Do you get the idea? Do you get the idea? Do you get
Yes.
the idea? But then here
Yes.
we'll put a middleman here who is the bank. I get it. So that A will now transfer to the bank and the bank will now transfer to B. So it looks like the loan came from the bank. So the bank is just used as a special purpose vehicle to transfer these benefits to B. Do you get it? But the actual beneficial owner is A. Do you get it? So this is what we call back-to-back financing, where you use a central entity or you use a bank to transfer the loan to this one. So GRA sees that, okay, so on the face of it, it's the bank who gave the loan to this guy, unless they dig deeper by applying maybe indirect payments under section 27, or they apply the principal purpose rule and then the general anti-avoidance rules under section 34 and section 99 of the RAA before they can track this. But sometimes you can mask this transaction such that they are not going to see. So it's like, is the bank issuing this to this, which is back-to-back finance. And three, you can use sale and lease back. How? So sale and lease back is one of the ways you can also bypass thing capitalization. So what you do is that, you see, A wants to give a loan to B, but then if he gives a loan, because they are group members, okay, the commissioner will catch you and apply the 3:1 ratio. So do you know what A will do? B will intentionally sell his assets to A. Do you get it? Then A will now give money to B as if he's paying him for the asset. Then A will now rent the asset back from B will now rent the asset back from A. Are you getting it? Are you following? B will now rent the asset back from A.
Yes.
Then B will now rent the asset back from A, and then A will be paying what? Then B will now be paying what? Rent. He'll be paying rent expenses to A. So it looks like, okay, I bought an asset from this guy and I rehired the asset again. So in effect, I gave you money and then you are paying me what? Interest for that money every year. So the rental expenses are actually interest payments in disguise. Do you get the idea? So that is sale and lease back. So I've given you money and
Prof,
taking back the interest. Yes, please.
if I may ask, the SPV thing, how common is it?
It's done all the time.
With
Plenty.
commercial banks?
It's done plenty. Just that sometimes you wouldn't see.
Oh, okay.
So I'll show you a typical example from one of the past questions, right?
Okay.
It's not always that you have to acquire. Big companies will acquire the bank themselves, but small companies, they don't have money, so they can do guarantees. So let me show you an example. Let me show you an example. There's Article 15. I'm coming.
My confusion here is assuming A has money, wants to give it to B, and the bank is the SPV. Who benefits from the interest?
It is A who benefits.
Okay. So the bank would deduct from B and give it to A.
Of course.
Okay.
That's the main idea. That's why most of the time, all of them are related parties. So that, you see, they are trying to mask the source of the ownership, the true owner, who we call the beneficial owner. And tomorrow I'll teach you how to identify beneficial owner from a transaction. There's actually a rule, and always CIT tested. Like last night, they brought beneficial ownership in terms of treaty shopping, right? The question 2. And most people, it was the easiest question, but they didn't have the eyes to see. There you get the whole idea. So let me see if I can find income from passive income. I'm coming. I think capitalization rules 200. Now, look at this question. It came in. Okay, so this is the one that came in February 2026, question 4. That was just last night. You can see Headroom PLC. Can you see that?
Yes.
Yeah. But I'm actually looking for ThinkUp, so I'm coming. I'm looking for the question to come right now. I think it's down there. Well, last night they even brought ThinkUp, but this is not the one. I want to show you the arms, the back-to-back financing that we're talking about. So see, look at this one. This one came. You see, think capitalization is a regular feature of your exam. Have you noticed? You see, last night it was there. That's the first question that came. Now look. Headroom Tech Limited is a company resident in Ghana and is 100% owned by the Atuati Group. Now, a company located in the UK. Okay, you can see that. Good. Now, ATL requires significant capital injections to procure what crashing manufacturing plants for its latest pro-medical product. In the year ending 31st December 2020, ATL borrowed 50 million for a 5-year term from Lome International Bank. Look at it all. He borrowed what? 50 million. No be so. Now, a financial institution resident in the Netherlands, Lome International Bank, has a branch in Ghana. A loan contract between ATL and Lome International Bank requires Atwat Group to place a fixed deposit investment equivalent to the loan amount with Lome International Bank as a guarantee for the facility. Do you see what happened? So look, ATL is in Ghana, Mewa. Is ATL not in Ghana?
Yes.
So it borrowed from Lome International Bank, which is where? In the Netherlands. No be so? And then the Atwat Group, ATL, the AT Group, the group itself, also went to, how much loan did this guy borrow from Lome?
50 million.
He borrowed what? 50 million. Is that not so?
Yeah.
Yes,
Yeah.
50 million. But they said this guy also has to place what? A financial guarantee of what? 50 million with Lome International Bank. So look at what is happening. So it's like this guy gave 50 million to the bank as an investment. And then the bank also gave 50 million to ATL as a loan. Is it not back-to-back financing? Is it not
It
back-to-back
is.
financing?
Yes, it is.
Did they actually own the bank? No. It's not always that you have to own. But then I told you can use financial guarantees. And the things I'm teaching you are in your questions. So you see, some of you learn the thing on the surface. Into corner bar, you don't know where to start. Adelai. Most of the time, you take question, you don't know where to start. It's because you learn it on the surface. You don't get the principles behind it. You use the principles to answer. Okay, so nowadays, the way your questions come, the chances for people to fail international tax is very high, and to pass through is very high. You just need the right information, how you present your answers, and I'll be talking more about that on Sunday. So now let's gain the knowledge. Do you get a whole idea? So you now see whether you can apply all those rules. So interest itself has withholding of 8%. You must always say it. You must apply the rules. And you see that it's still the same things we are seeing. So you see interest that they paid was 3.2. The exchange rate was 8.5. The equity capital was 10 million. Loan amount was 50 million. What is allowable loan? It's 3:1, right? 3 times of the equity. So 3 times of 10 million is what? It's 30 million. But you charge interest loan of what? 50. No, be so. Has it exceeded? Yes. It is above the 3:1. So you limit it to the 3:1. So the interest paid, you can allocate it, right? You can limit it to the 3 out of 5. Do you get it? Any excess interest will be disallowed. That's all you see. Okay. So, I mean, that's it. Let's see the one that came last night. Are we getting what I'm trying to put across?
Yes, sir.
Good. So let's look at what came last night. Yeah. Okay, this one was not the one that came last night. I think it's at the top there. So Adamfo Beverages Limited is a Ghanaian resident company that manufactures and distributes specialty non-alcoholic beverages. It is jointly owned by Odo Foundation, a Ghanaian resident holding 40% of the shares, and SIFO SA, a South African resident company holding the remaining 60%. SIFO SA itself is a wholly owned subsidiary of Global Sipcorp, a multinational company resident in the Netherlands. To fund its operation, they secured intercompany loan. So immediately you hear intercompany loan, you know they are talking about what? Think up. No be so? So you have to check whether the interest is in line. So you see the loan balance was 12 million. Interest paid was the stated capital retained earnings. So we need 3 times of this equity. True or false? That's 3.5. 3.5 means Sabema is saying whether it's in line. So this times 3 will give us what? Stated capital plus retained earnings.
7.5.
That's 3,500.
10.5.
7.5. No.
10.5.
7.5.
No, 10.5.
10.5.
10.5.
Yeah, it should be 10.5. So
Yes.
10.5, right? But the loan we went for was what? 12 million. Has it exceeded? Yes. So we
Yes.
subject it to think capitalization rules. So this interest will be allocated, right? According to the think cap rules. Then you talk on the various provisions, which I'll teach you tomorrow on how to deal with beneficial ownership and special purpose vehicles and the rest. And you chip all inside the question, you get the full 20 marks. All right. So that was just by the way. So that was about think capitalization and how to bypass think capitalization. So now we go to intangible assets and then intra-group services. And then maybe I can close there, right? Because the time is not even on our side. So that tomorrow when we meet, we'll finish. Yes, please.
So you mentioned APA. Is it also another way to bypass think up?
Yes, but that one comes with a safe harbor. So with APA, you enter into arrangements with the revenue authorities ahead of time before it actually happens. So let's say you decide to go with this method ahead of time. So it's like you set a particular method with GRA before the transaction actually happens. Do you understand? Yes, it can be used as a way. Because before you even entered into the transaction, you say, GRA, I'm going to give this loan, but I expect us to handle this transaction this way. And if GRA agrees, then it means you are safe. You understand? Even before the day of the loan. Please, are we okay?
Prof, what time is the class tomorrow?
6 p.m.
6 p.m. Okay.
I would have done it during the day, but I have other classes, so. Okay. So.
But Prof, is it possible? I realize you've recorded it. Is it possible? Some of us joined very late. Is it possible to
No,
have
it's
it?
streaming on YouTube. It's on the YouTube channel from the
Oh,
start.
okay. Oh, okay. So we can get it on the YouTube channel.
Yes. Including
Oh,
other.
okay.
So yesterday, I have shared I was supposed to meet you yesterday, but I used it for my advanced taxation practice students. So I sent you videos on PE and residence and foreign tax credits, which you'll be getting, and then double taxation and the connecting factors, including the interpretation of treaties and then the life cycle of treaties, which is coming. Okay. So those videos, always the first video I give you, if you don't take it serious, you go meet it in the exam hall. I've already told you those things are coming. So if you like, don't watch. Do you get it? So I've already given it to you. So tomorrow I'll focus more on the articles. So passive income articles, interest, dividend, fees for technical services, and the other ones, including PE and how it relates to those articles. Then on Sunday, I'll do residence and other connected articles, including exchange of information, depository institutions, investment entities, resident insurance entity, and the common reporting standard. Okay, then I know that you've done substantial part. Then labor mobility in international tax, so tax equalization and tax protection. So those things are also there.
Okay, Prof, what's the channel? When I go to YouTube, what's the channel? Where
So
can I
go to
get it?
Profs Tax Academy. There's another one with Profs Training Solutions. If you want other resources on my international tax, you can go to Profs Training Solutions. Then there's Profs Accountancy Solutions. So you can get
Okay.
information there. But the one that I'm posting this on is the Profs Tax Academy.
Prof Tax Academy. Okay.
But in
Okay.
case you watch those ones and you want further videos on the other ones, you can go to Profs Accountancy Solutions or Profs Training Solutions.
Okay.
All right.
Okay.
So,
Thank you so much. It's helpful.
good. So please, are we okay now? So let's look at how to deal with intra-group services. So.
Oh, I thought you said tomorrow.
No. We have to finish intra-group services and intangibles right now. I'll do it very quick.
Okay,
So.
that's
So when we talk about intra-group services, okay, so when we are offering services among the group itself, right, there are two major considerations. One is that, was there a service? Do you get it? So one, was there what? A service? And two, or does it meet the definition of a service? And two, what was the charge? So to determine whether the thing was actually a service, there are some rules that you need to follow. Do you get it? I said, anytime there's an intra-group service, what do you consider? One, was there what? What did I say?
Was there a
Service. Was there a
And
service?
was
And
there
two,
a charge?
yes, and two, what was the charge for the service? So first, the thing itself, we must check if a service has actually been rendered. And two, how much did we charge for it? Do you understand? So last night they brought intra-group service and people didn't even see that they were asking of intra-group service. Okay. So intra-group service is very, very important for you to know it because it can be examined every night. Because mostly multinational companies like group services a lot. Okay, so the first thing to check whether a service has actually been rendered is the benefits test. So when we say the benefits test, we are saying that, okay, are you expecting to get some commercial benefits? Are you getting, or some economic value from that service? If somebody, an independent party, okay, outside the group would want somebody or will be willing to pay for that service because he's going to get some commercial benefit for it, then it passes the benefit test. So far as that thing, me myself, look, if the group wants to do HR, okay, for you, and you can pay, you would want to pay an independent party to do that HR for you because you expect that doing HR will give you the best stuff to use and it will increase your profit. Then has it passed the benefit test? Yes. But if they are giving me a service that I don't think I'll benefit from and I will never ever use my money to pay somebody to do it for me, that means it shouldn't be a service because it doesn't meet the benefits test. Because there's no commercial economic value that will come from that service. Do you understand? The next test or the next thing you should look at is duplicated services. So these things are not services. Okay, so let's say if I'm doing the same way I say you have HR, right? And the group wants to do HR for you. Is it not duplicated service? Is it not duplicated service?
Yes, it is.
So is it a service? It doesn't meet a group service because I'm already doing HR. And then you want to do HR for me. It means it doesn't make sense, right? You are just duplicating what is already there. So will I pay somebody to do HR for me if I already have HR? No. So duplicated services do not constitute intra-group services. Then let's look at incidental benefits. So for instance, let's say that as a result of the group, okay, the group is giving everybody some financing or easy loan with GCB Bank. And as you didn't want easy loan with GCB Bank, you bank with Fidelity. But because the group itself is giving all the members easy access to loans at GCB Bank, you got access to that service. It's just incidental to you. But would you have paid somebody to do that service for you? I'm asking the class. Would you have paid somebody to do that for you?
Prof, please go over.
I am saying that you bank with Fidelity. You get all your loans and arrangement with Fidelity as a subsidiary. You have nothing to do with, when it comes to financing, you handle your own thing. Then the parent company secured a benefit with or an arrangement with GCB Bank to give all the subsidiaries what? Says a sort of easy financing with GCB Bank. And I'm saying that this one, you got that benefit. It is incidental because you yourself will not request somebody to do it for you. Do you get it? Because you bank with Fidelity. I'm saying that, would you request an independent party to do this with GCB for you? No.
Oh, no.
But you got it because you were just part of the group. Do you get it? So activities like this means that it is just an incidental benefit. Because it came as a result of you being part of the group. But you yourself, you will never pay an independent party to do something like that for you because you already bank with Fidelity and you use Fidelity services. So in that case, you are not really getting a direct economic value you are expecting. It just came as a result of you being part of the group. So it doesn't constitute what? Intra-group service. Then let's come to another one. Centralized service. Okay. If the parent is providing services to its subsidiaries, are you getting it? So if the parent is what? Doing administrative function, finance, and the rest for each of its subsidiaries, but as a centralized service, it constitutes intra-group service because that centralized service, would you have paid somebody to do it for you? Yes. So far as you pay an independent party to do the same service the parent is doing, it constitutes intra-group service. Also, we have shareholder activities. If you are doing shareholder meetings and anything concerning shareholders, I get or members of the company, it doesn't constitute an intra-group service. Are you getting it? That's what I was saying, shareholder activities. Then finally is what we call on-call services. So look at what happens. If you yourself, you are there and you see that you lack financial management or your finance is bleeding, then you call the parent company or one of your subsidiaries to tell him that, you know something, I want you to come and do internal audit and manage my financial management for me. Let me ask you, is this something you can request another person to do for you for a fee? Yes. Because on-call services, instead of calling a subsidiary or a group member, you can call an independent party on the street to come and do for you. It makes it look like a legit service that meets the arm's length principle, meaning an independent party can do it for you. And because of this, it means that it also constitutes what intra-group what service. Do you understand? So intra-group services, what are the things you consider? And that's what they asked them last night, and most people missed it. So I said always consider the benefits what? The benefits test. Then 2, we looked at what? Duplicated what? Services.
Service.
Is it a service or it doesn't meet the definition of a service? It doesn't meet the arm's length principle, right?
It doesn't.
Then
It
we say what?
doesn't.
Incidental what?
Benefit.
Incidental benefits. Does it meet the definition?
No.
No, because it's just incidental. So centralized services. Does it meet the definition?
Yes.
Yes, because this one you can request it from someone to do it for you. On-call services. You called for it. Does it meet the
Yes.
definition of a service? Yes. Shareholder activities.
Yes, it
Does
does.
it meet the definition of a service? No.
No.
Because you doing activities for your shareholders is your responsibility as a company. It has nothing to do with intra-group services. So this is what you test. Do you get it? Then with the charge, you have what we call the direct charge. Direct charge means that you can directly allocate it to the group member. So if this guy did finance and you're paying $5,000 per month, that is the charge. It is direct. You know that this guy did it. But when it came as part of the group, you don't know how to charge it. That's why we use the indirect charge. And the indirect charge, we use an allocation key. For instance, you go to a house, right? If we all have meter, then when the light bill comes, we can easily give everybody his light bill. True or false? Because the meter will read it. That's what we call direct allocation. But if the house uses the one meter, can we tell how much every person gets for the electricity bill? Can we tell? If there's only 1 meter in the house, can we
No.
tell how much everybody will get for electricity bill?
No, no.
So what do? We can use
Unless
some
you use some
appropriate
basic for the
base
allocation.
to allocate or apportion, right? Maybe we can use the number of what?
Points. Gadgets
Number of
or
gadgets that you
appliances.
use or appliances you use in your
Yes.
house to apportion, right? Or we
Yes.
can even use
Compound house had apportionment.
or we can even use the size of the room to apportion. That's what we call the indirect charge.
Or per head.
So the indirect charge or per head, the number of people. Thank you. So this is what we call the allocation key. Do you get it? So if this service we want to share, assuming it was to the entire group, we'll lose some sort of allocation key, like the floor area. Are you getting it? Or maybe the kilowatt hours used for the electricity or this. So we'll use those things as our allocation keys to split the what? The charge to each of the group members. Do you get it? But when everybody has their own meter, that one we can tell that A has this amount, B has this amount. So that's the direct charge. Are you getting it? And because these are services, the most appropriate method is the cost plus method. Do you understand? So you remember we talked about what? Intra-group, low value adding intra-group services. And I told you that in our is the simplified approach. Do you remember? And in our transfer pricing regulations, it's 3%, but in the OECD, it's 5%. Do you remember? And I told you that low value adding intra-group services are the ones that are routine in nature. They don't add any value. Like support, routine support, calls to management, receptionists, and the normal basic administrative functions. You can get any Tom, Dick, and Harry to do it even at his house for you. Do you get it? So this is all about intra-group services. And last night they asked them, and it was shocking that most students didn't even know they were asking about intra-group services for 8 marks. Can you imagine? Let's see. Let's see what happened last night. Let me see if I can. Intra-group service and one new. And when it comes to people cannot even answer. Was it difficult? Was it difficult? 361.
That is if you have read. You know.
Some people have read, but they still don't understand. Because these things, they are complex in real life. But that's why I try to break it down for you. Do you understand? Look at this question that came last night. Question 3A. So the global tax manager of a multinational group of companies has approached you as a tax advisor to provide transfer pricing advice in relation to a proposed services hub company that will be established for the provision of services to all associated enterprises within the group. Is it not intra-group services? Students knew this, but they were expecting the question to say intra-group service before they can produce what we said. But you see, when you read it, it says they are setting up a subsidiary who provides services to all associated enterprises within the group. Is it not intra-group services? So explain the fundamental transfer pricing issues that should be considered by the global tax manager. What are some of them? 1, whether the service meets the arm's length principle. 2, what is the charge? So under whether the service meets the arm's length principle, what are we looking out for? Benefits test. No be so. Duplication of services.
Yes.
Incidental benefits. On-call services.
On-call.
Centralized services. Shareholder activities. Then when it comes to the charge, we are looking at whether it's a direct allocation, direct allocation. Then the appropriate method to use for transfer pricing, mostly the cost plus. Then you get your 8 marks, you are gone. Intra-group services gone. It was a wonderful meeting. I believe we have learned quite a lot. So we are halfway done with transfer pricing. We are just left with intangible assets, transfer pricing reports, and then the methods of transfer pricing, which I'll cover tomorrow before we start with PE. May the Lord be with you once again.
Yes.
Amen.
Thank you.
Thank you, Prof.
God bless you.
How did you see transfer pricing today? Was it simplified?
Interesting.
Prof, I thought you were going to do the intangibles tonight before we sleep because that was very emotional.
We'll do it tomorrow.
Okay.